analysis, and what we'll be looking at today is technical analysis. Hello learner, welcome to Manifested e-learning forum. My name is Emlyn Gwiri. I'll be taking you through equity investment analysis, and what we'll be looking at today is technical analysis. And what specifically we look at under technical analysis, The specifics we will be looking at today include, we will start by looking at introduction, where I will be able to briefly explain the mechanics behind technical analysis. Then after the introduction, we'll look at the technical analysis principles. What principles guide technical analysis? Moving on, we will move on and look at the logic behind technical analysis. Then once we've looked at that, we will move ahead and look at the types of charts used in technical analysis. So what types of charts? Specifically, we will look at the following charts. We will start by looking at the point and figure chart. Point and figure chart there. Then we will look at the line chart there. We'll move ahead and look at the bar chart as well. And then we will finalize by looking at the Japanese candlesticks. Japanese candlesticks there. Then once we've looked at these types of charts, we will move ahead and look at the door theory. Then we will be able to conclude this first lecture under technical analysis. Now, we start off by looking at the introduction to technical analysis. Why is the introduction important? The introduction will form the sound basis as to why we are conducting or understanding technical analysis. Why are we learning technical analysis? The introduction will try and create that or arouse that interest for you, the learner. Now, what I can be able to explain under the introduction goes like so. Technical analysis tries to cover up where fundamental analysis left off. Fundamental analysis looks at the identification of the intrinsic value of a security or an asset. That is what we have been doing by looking at the free cash flow method. We've been looking at the free cash flow method. We have mentioned about the dividend discount model. We've also looked at the price multiples. We've looked at the residual income. Using those models tries to identify the intrinsic value, the true and fair value of a security or an asset. So that once we've identified the intrinsic value, we are able to compare it with the current market price there, such that if we have the current market price, I can put that initials like that, is greater than the intrinsic value, then you are saying that the security or the asset is overvalued. So if the current market price is less than the intrinsic, it is the opposite of that. We are saying it is undervalued. Current market price is equals to the intrinsic. It is correctly valued, like that. That is what we have been doing by trying to look at those models that govern fundamental analysis. However, what fundamental analysis doesn't do is to try and explain the short-term price movements. What am I saying? These short-term price movements can be able to dictate whether there is going to be an uptrend or a downtrend, like that, which we will be able to try and demystify under technical analysis. What technical analysis does, technical analysis tries to step in and tries to identify cyclical patterns in the price movements of securities or assets there. We're trying to identify trends or trend movements. That is what technical analysis does, and it tries to fit in, especially more so in this short-term period, trying to identify which securities to purchase during the short term there. Probably you might have experienced this when going into an investment bank or a stock brokerage firm. You would want to purchase securities for the short term. Fundamental analysis cannot be able to assist the analyst to make a decision and trying to identify the securities to purchase. That is where now technical analysis comes in. And we will be shortly looking at the technical analysis principles so that we can be able to reinforce our understanding of this topic. So we can be able to mention something right here. You can say technical analysis tries to identify or assist the analyst stroke investor in decision making as to which securities or assets they should purchase. They should purchase or sell. Now I'll explain the concept, the mechanics behind fundamental analysis and why now technical analysis tries to fit in the shoes of fundamental analysis. Fundamental analysis only tries to identify an assets stroke securities intrinsic value. And we had explained in the topic under return concept what the intrinsic value is. I'll just recap on what we looked at. The intrinsic value is the true and fair value of an asset. What an analyst believes the value of the security should be based on the four valuation models we had looked at. The four valuation models include, I'll reiterate again, the free cash flow, the dividend discount model, the price multiples, and the residual income. We are trying to identify the intrinsic value, what the analyst or the investor believes the value of the asset should be. And you compare that with what the Securities Exchange provides as far as the pricing of the security is concerned. So if the current market price, which that one that is issued by the Securities Exchange, is if it's greater than the intrinsic value, the one that you've computed, then we are saying that the security is over or undervalued. So we are saying that the fundamental analysis only tries to identify an asset or security's intrinsic value and compare that value with the current market price. The decisions made under this approach is long-term in nature. It's long-term in nature. So when trying to identify using fundamental analysis, you're trying to identify after some period of time, you expect the share price to either be undervalued or overvalued there. Technical analysis, on the other hand, tries to identify securities stroke assets that should be purchased or sold, in the short term. Because you're saying that short-term price movements tend to also impact or create longer-term price movements over a period of time there. So that is the brief introduction that I have under the introduction to technical analysis. We are saying that technical analysis may play a very critical part, especially when trying to identify small short-term movements or movements within the short term, which is say within 1 to 2 years there. So now moving on from the introduction right here, we will be able to move on and look at the technical analysis principles. What principles guide technical analysis? So we say principles of technical analysis. There. Now, having looked at and understood what the introduction or the mechanics behind fundamental analysis and technical analysis, the first principle states like so, that prices are determined. Number one, we can say prices are determined by forces of demand and supply. By forces of demand and supply. So we are saying that the demand for securities, if we have that demand curve here, so we have price and over here quantity like that, the forces of demand and supply. The demand curve is this one. If I recall my economics, I remember the demand curve would go like that. And the supply curve would increase. You'd want to supply more to the market if the prices are increasing and like that. So that is the demand curve, demand versus supply curve there like that. And that is the equilibrium price. So we're saying that technical analysis is primarily driven by the forces of demand and supply. How many individuals are demanding the security or the asset versus how many individuals are supplying the asset to the market. So there must be something to do with an equilibrium price, the price that is acceptable to both the buyers and the sellers. Number two, the second principle states as follows, that the demand and supply forces, the demand and supply forces, talking about that demand and supply curve there, are influenced by fundamental factors. Forces are influenced by fundamental and psychological factors. Fundamental and psychological factors. Psychological factors. There. We are saying the fundamental factors uses the information that is provided in the financial statements for companies. So the fundamental factors, I've already explained what fundamental analysis only tries to do, tries to identify an asset's intrinsic value there. And psychological factors are the belief that any investor has for themselves, that I believe, for example, that KCB within the short period, within the short run, will be able to increase by say 50% or 70%, like that. That is what you're saying is the individual factors that affect or that influence or support rather technical analysis. The third one, as follows, is that the fundamental factors can be psychological, can be quantified. We're talking about the fundamental factors can be quantified and the psychological factors cannot be quantified. So we say that the fundamental factors can be quantified, whereas the psychological factors cannot. So the fundamental factors, we're talking about trying to identify the intrinsic value, where we use numbers or figures. We can be able to at least identify that you're comparing the current market price versus the intrinsic value there. So at least that one can be quantified and like that, and a decision can be made using that. We are saying that psychological factors cannot be quantified because you cannot be able to identify individuals' perceptions about a particular stock, or neither can you also be able to quantify, say, the behavioral biases, because we are saying that behavioral biases can influence the market trends, either moving up or moving down, like so. Then we can also say that the combined effect of the fundamental factors and the technical factors is reflected in security prices. So I can come on this side over here, say that the combined effect you can say that number 4, the combined effect of fundamental factors and technical factors what can we say? We can say that it is reflected in the price movements of securities or assets like that. That is the 4th principle that guides technical analysis. We can look at the 5th one there, and we say that past price movements assist in the prediction of future price movements or trends there. So those are the 5 principles that guide technical analysis. The first one, prices are determined by forces of demand and supply. The demand and supply forces are influenced by both fundamental and psychological factors. Then I've said that the fundamental factors can be quantified, whereas the psychological factors cannot be quantified. The fourth one here is the combined effect of both fundamental factors and technical factors is reflected in the price movements of securities or assets there. So these technical factors here and fundamental factors work in unison, like that. Then we are saying that the past price movements assist in prediction of future price movements or trends. So we are saying the use of graphs and charts can be able to dictate or provide some bearing as to which direction the share price will move. Is it either going to be 1, 2, or 3 right there? So that is what we're saying. The analysis of past price movements like that can be able to dictate the future price movements in at least the short term. There. Now, having looked at the technical analysis principles that, there, let's look at the logic behind the technical analysis there. Logic behind technical analysis there. Now, the best way to describe the logic behind technical analysis is to use a graph. A graph of price against time is the best example that we can be able to use to try and understand that concept, the concept of technical analysis. So we are saying this is the price there, and this is time there. So we have the old equilibrium price there. We have it going down like that, and then we have like that. So we can be able to say this is the old equilibrium price, because you are plotting a price against time like that. Then this is the new equilibrium price there. This part right here is when the information is being released into the market. So when the information has been released to the market, investors decide or that they're not going to take up the new security, or the company's mechanics or the specifics dictate that it should be able to go down there, and less demand for that security will reduce the price of that security. So we say here is release of new information. This is just a hypothetical example that I'm explaining. It could be also the other way around. So we could have like that, a graph up to there, then it goes like that, and then we can be able to put it something like that. So we say this is the old equilibrium price is much lower, then we can be able to have the new equilibrium price being much higher as compared to that. But this is just a simple explanation that can be able to guide the logic behind technical analysis. So that is what we have there. Now, having looked at the logic behind technical analysis there, we can be able to look at the types of charts and used under technical analysis. So we move on to look at the types of charts and used in technical analysis there. I hope this has actually provided some guidance. The logic behind technical analysis is simple. You just need to plot a graph of price against time, and you understand the impact of release of new information. Once information has been released to the market, then that creates or arouses some interest or disinterest. Meaning that in this case over here is a disinterest. This first graph that I do over here. So this is the old equilibrium price. The price was much higher over here. Then the release of new information, possibly negative information, reduced the amount of demand for that security or asset, and hence now the new equilibrium price is much lower than the old equilibrium price right there. However, in this dotted line which I've drawn moving up like that, this part over here indicates the old equilibrium price, which was much lower. The release of new information within that part over here aroused interest or aroused some form of some form of demand for that security, so that you can be able to see over here that the new equilibrium price is much higher than this dotted line which began over here. So the logic behind technical analysis is just driven by forces of demand and supply. That is what I can be able to explain under the logic behind technical analysis. Now, moving on, let's look at the types of charts used in technical analysis right there. So I can come on this side here. Look at the types of charts. So types of charts used in technical analysis. Now the first type of chart that we are going to look at is point and figure chart, or rather let me start first of all by looking at the line chart. Yes, let me just start right here. I'll be able to explain all of them anyway. So the line chart. Now a line chart is a simple plot of price against time. Now this is how I can be able to demonstrate a line chart. Now we are saying here we have price, like that, price against time, like that. And as time goes by, the forces of demand and supply changes the price of the security or the asset. So you can begin there, it moves there like that, it moves down like that, moves as it moves up like that. So we are saying this is a line chart there, indicating this as time is moving at this part over here. You can see is different from this part, it's different from here, and so on and so forth, like that. That is what you're saying is a line chart. You just plot the prices against the time, or as time moves on, you can be able to plot the security and price pattern. So this is a line chart there. Now we look at what a bar chart is. A bar chart right there. So a bar chart is a chart that is drawn like so. You can draw it right here. That. Then we can say that this is just the plot of price still against time, like that. But now in this instance, what will happen is that we are going to plot now the starting price, the opening price, and the closing prices like that. Here is the midpoint there. Then as we move on like that, we plot like that, a bar chart like that, and so on and so forth like that. So you can be able to clearly see that this is an uptrend, or the trend is moving in that direction. As well in the line chart, you can also see this an uptrend moving in that direction. However, if it's moving down like this, say from over here, we can be able to decide maybe it goes down like that and moves down like that, moves down like that, and this is now a downtrend that is moving like that. That is what we can say is a bar chart. So I can indicate over here, just over here, number 2, bar chart. Now, having looked at those two, let's look at now the point and figure chart. The point and figure chart right there. Under the point and figure chart, a plot of only prices is provided, but now in a very different and unique way. The plot against price alone is the one that is used. So we are saying this is what we have like that, and then we don't have an x-axis there. We only have the y-axis here. So here you have price prices of securities like that. And you're saying if you have a rising trend, you can be able to indicate that is for a specific time period, say within 1 hour, and the prices have actually increased up to that level there. So this is, say, for example, 200, 201, 202, 205, 207, 210, and so on and so forth as we increase like that. However, after this 1 hour, you can be able to find that now the prices have begun to reduce. So you find that this is what happens. We can indicate the reduction using circles like that. And if there is an increase in prices as well, we can be able to continue and put X's like that. And if it's a downtrend, then we can be able to indicate like so, and so on and so forth like that. That is what you're saying is a point and figure chart. We can also plot a point and figure chart using the actual prices. So we are saying that over here, if you can be able to have, say, a parallel diagram right just besides this point and figure chart right here, and indicate now the prices over here. So we indicate, instead of having the x-axis indicating the prices like that, we put it now on the graph itself. So we have 200, 201, 202, 205, 201, 210, 210, and so on and so forth like that. Then you find over here now reduction, 205, 202, 201, 200, 199, 198, 97, and so forth like that. Then we have now 201, 202, 205, 207, 209, and so on and so forth like that. So you can see there's a slight difference between this point and figure chart and this one, but you can be able to induce some kind of or infer some kind of decision over here. You can see this is the congestion area or the concentration area right above this part over here. That's what you're saying is the congestion area like that. Now, having looked at these three, we can say this is the third one over here, point and figure chart there. Then finally, we can look at the Japanese candlesticks over here. Why these are important is because technical analysts believe in the use of graphs and charts to try and identify price trends that can be able to assist them in making decisions as to which securities to purchase or assets to purchase. Number 4, we're talking about Japanese candlesticks. That Japanese candlesticks. Now, what you need to understand under Japanese candlesticks is, first of all, the look of the candlestick itself. A candle looks somewhat like that. Here, before I put this wick over here, I can be able to have that body indicating over here opening, price, closing, price. We can have like that, or we can be able to have another Japanese candlestick like this, where we have the closing price and opening price like that. So you can see this is the opposite of this one. Here you have the higher closing price, and here you have a lower opening price like that. Now, putting that understanding onto a graph, this is what we come up with. We have a graph like so. And put it somewhat like that. Then we can be able to identify now, we can draw now that candlestick over here with that and that. What I didn't explain on these graphs is that here you can be able to have the wick over here, you have the highest price, highest price, and here you have the lowest price like that. So you'll have candlesticks like this moving in this direction that provide some guidance to the analyst or the investor that this is a bullish trend. A bullish trend means that it is moving in an upward direction like that, with even highest price happening, higher opening prices or even higher closing prices. Remember, if you're looking at it from this perspective over here, you'll have the opening price being over here, the closing price being much lower. But now, this scenario is usually very typical when you're having a bullish trend, where you have a closing price moving higher and higher and higher. So here you have the closing price, closing price, closing price, closing price, and so on and so forth like that. But now when there's a bearish trend over here is where you'll be able to see that the closing price will tend to be much lower than the opening prices like that. So that should be understood from the Japanese candlesticks perspective. So here we have the price, here we have time moving in that direction. These Japanese candlesticks are the most commonly used by technicians because they indicate the closing prices and the opening prices in a probably maybe systematic fashion compared to the other charts that we've actually looked at there. Now, having looked at the four types of technical charts, technical analysis charts right here, now we move on to look at the Dow theory. Dow theory. Charles H. Dow was an editor of the Wall Street Journal between 1900 and 1902. Being an editor, he was the founder of the Dow Jones Industrial Average and the Dow Jones Transportation Average there. Those are indicators that assist technicians or technical analysts to identify price movements. What we need to understand under the Dow theory is that the historical price movements like so, these historical price movements like that can be able to provide an indication for the price trend that is going to occur in the future there. Now we look at the principles backing the Dow theory. Principles of the Dow theory. Now, Charles Dow said that the price movements of securities move in three directions or three movements: the primary trends, the secondary trends, and the minor movements. Take this example. If you have, say, a bucket full of water like that, this bucket and it's full completely, you hit it on the side like that, you will be able to see the ripples moving towards the center like that. Those are representative of the minor movements. You hit it slowly, or if you hit maybe say a cooking pot like that which is full of water, you'll be able to see ripples moving like that. That represents the minor movements. That. Now, the primary movements and the secondary movements, the primary movements are synonymous to what we can be able to say tides, and the secondary movements are similar to waves. Waves are smaller than tides, and the minor movements are the smallest like that. Putting it all together, before I actually come to the principles of the Dow theory, what I can say is this: if you have a price movement moving in that direction like that, this would be able to now indicate that's the actual price movement. So you will find the price movements, or you're saying that you have the primary movements indicative of that movements like that. I should have probably used maybe a fainter kind of marker like that. So this is the security price that is moving like in that direction. So we can be able to have like that the price movements moving in that direction. That is what we're saying is the secondary and the primary movements there. The secondary movements are usually smaller like that guide the direction movement of the price like that. The minor movements are indicative of very small movements of prices in that direction, similar direction of those two other trends like that. That is what we're saying is the Dow theory. The Dow theory has got three postulates, and the postulates or the principles are as follows. Number one, we can say like this, that all information that is guiding the Dow theory there is reflected in the averages of market prices. So all information is reflected in the averages of prices, of market prices. And those averages, what can we say? We can say that those averages reflect market movements. Those averages reflect market movements. That is the first postulate like that. I shouldn't have put it in form of bullet. I should have put it like that. That is the first principle. The second principle can come on this side right over here. You can say that the averages exhibit three movements. Averages exhibit number two, pardon me. The averages exhibit three trends, full colon, primary trend, which is representative of tides, secondary trend, this is trend, it represents say waves, and the minor trend, which represent ripples. That. Number three, all the three trends move simultaneously. All the three trends move simultaneously. So those are the principles that guide the Dow theory. This comes to the end of our first lecture of technical analysis. We hope that you can be able to join us in our next lecture, where we will continue with the same topic. Thank you. God bless you.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tomboya Street, Pioneer House, 3rd floor, opposite Fire Station.
Hello learner, welcome to Manifested e-learning forum. My name is Emlyn Ngwiri. I'll be taking you through equity investment analysis, and the topic that we're looking at is technical analysis. In today's lesson, we are going to look at the following. So we are going to look at, the first thing we're going to look at is primary trend. Then we will move on and look at secondary trend. Like that. Then we will move on to minor movements, like that. And these are the principles that underlay the Dow theory: primary trend, secondary trend, and minor movements. Then we will look at the interpretation of trend lines. Interpretation of trend lines, like that. Now here specifically we'll look at uptrend, that. Then we will look at the downtrend and no trend. Down trend, trend, and no trend, like that. Then we will move ahead and look at the prediction of the market using the Dow theory. Prediction of the market using Dow theory. Or that. And then we move ahead, we'll be looking specifically at the Dow Jones Industrial Average and the Dow Jones Transportation Average there. Moving on, we will look at the support and resistance level. Support and resistance levels, like that, and try to explain the reasoning behind the support and resistance levels. Then we move ahead and look at chart patterns. Yeah. Then we'll move ahead and also look at the reversal patterns. Reversal patterns. And finally, we will look at the trend lines. Trend lines, like that. Now, this is what we will look at today. And we start off by looking at the primary trends. Primary trends. Yeah. Now, the primary trends, as explained in lesson 1, we had said that the Dow Jones, the Dow theory is governed by 3 trends: the primary trend, the secondary trend, and the minor movements. And I will be able to demonstrate the primary trend as follows. So we will be able to draw how the primary trend looks like and we'll try and superimpose the primary trend, secondary trend, and the minor movements on one graph, like that. So here we have increasing, like that, the prices. Here we have time, like that. So if we have the primary movements move in form of trade. So this is the security price that is moving like so. For example, it's moving like that upward direction, bullish trend. This is now moving up. Bullish means that it's moving up. Bearish means that it's moving down, like that. So trying to explain the primary trend, it is in form of waves, rather tides, like that. So that is an indication of a bullish trend based on the primary trend. How different is that bullish trend from the primary trend from the secondary trend? Now, the secondary trend is a movement in smaller patterns, like that. So it just follows the primary trend, but now in smaller, what we can be able to call them as smaller waves, like that. Superimposed on this, we can be able to explain the minor movements. So the minor movements now follow the trend, the general trend, but now in smaller, what you can say, smaller movements. That. So you're moving like that. So the primary trend is the bigger wave that moves like that. I can be able to demonstrate right just below this. This is the main graph over here that we're looking at. Wait, you have superimposing, and you have the primary, secondary, and tertiary trends superimposed on each other. But now, trying to explain the primary trend, this is still prices, like that. Here is time, like that. So we can be able to just explain now the primary trend, because that is the major topic that we've actually talked about over here. So if the security price is moving like that, so you can say that this represents primary trends. can say this is A, primary trends, like that. That is what we have looked at there. B, say this is A, now this is B, secondary trends. So the secondary trends move in smaller prices, time. That. So if you have now, we can be able to use bearish trend like that. This is bearish trend like that. So we can be able to say now they're moving in small waves like that. This is what we're saying is a secondary trend. It's much smaller as compared to this one. You can see this one is much bigger there. This one is much smaller there. C, so you can say you can use this B, secondary trend line, but here is primary trend line. So you can be able to see it like that, and this is the primary trends like that. Now we can be able to now draw finally the minor movements. Prices, you can put this right here. We have prices. Here we have time. So we can be able to say, if we don't have a trend, we can give another description over here. If the prices are moving somewhat like that, over here we can have very small movements like that, which are indicative of a minor movement. So here we have C, minor movements over here, and we have minor movement line. C, minor movement line, like that. Now, having looked at the primary trend, now here we have the primary trend. This is the major line, here is the primary trend like that. And we are saying that this is now the big tide over here. This is the wave, and this is the minor movement. We can move on to interpretation of the trend line. So you've looked at the primary trend, the secondary trend, and the minor movements there. Now we move on to look at the interpretation of trend lines there. So let's look at that very quickly. We have interpretation of trend lines. Interpretation of trend lines. Interpretation of trend lines. Now here, more specifically, we had said an uptrend, a downtrend, and a no trend over here. And so we are saying in an uptrend, we can show it like this. So if we have prices moving like that, this is prices, this is time here, we can be able to draw a line like that. As well, we can be able to also draw a line like that, and this is an uptrend, bullish trend, like that. Now this is an uptrend, so once you see security prices moving in that direction, generally of course you don't expect them to move like this. In practice you might expect them to move somewhat like that, not very straightforward lines like that. This should be indicative of an uptrend like that. However, so you can say this is an uptrend, A here, uptrend like that, B, we have downtrend, downtrend like that, and we draw a downtrend like so. This is prices, this is time. So downtrend moves now the opposite of, and then we can be able to probably draw what we can call a channel like that. So that one not very perfect. It's good to be perfect sometimes, not all the time, but you can try that. So that is a downtrend, what we can call bearish trend there. Now a no trend is where the market moves in a fashion that does not indicate, or in a way that does not provide any indication of a trend. And I will demonstrate that shortly. Where we have like so, we can use this to make sure at least we are accurate, almost accurate. Time, that. This is prices, that. So we're saying if trend moves like that, then we don't have any movement in any particular direction. It's neither is it moving in a bullish trend, neither is it moving in a bearish trend over here. So you can say here, see no trend, like that. Now, having looked at the interpretation of trend lines there, we move on and look at the prediction of the market using the Dow theory. We can look at the Dow Jones Industrial Average and the Dow Jones Transportation Average right here. So this, we've actually done the uptrend, downtrend, and no trend there. So moving on, this Dow Jones Industrial Average, Dow Jones Transportation Average provide an indication of when to buy a security and when to sell a security. So the best way to demonstrate this prediction of the market is to use a graph. So I can use this part right here. Draw it like that. Not be very perfect, but at least I'm trying my best. Prices. Yeah. And here we have time moving like that. Probably that line may not be the best. Let me just redraw it again. Trying to consider that. Yeah, I think that's better. This is time. Yeah. Now, the Dow Jones Industrial Average is usually much higher. It has got generally higher prices as compared to the Dow Jones Transportation Average. Now, we can be able to just draw roughly how the Dow Jones, it's just like an indicator of when to buy securities and when to sell securities, like that. So we can say Dow Jones Industrial Average Index. Now we can have, probably can have something like, this is when to buy and when to sell. Probably it may not be the best. I can just rub somewhere here and maybe change it a bit. Like that. That. Yes, let's put it like that. Draw lines like that. Also like that. So if we can be able to just draw the Dow Jones transportation average right here, like so. So this should be somewhat like, should have been actually at the bottom part, yes, like that before. Now it rises again like that, something like that. So they almost follow each other, the same fashion here. So this should indicate a sell signal, and here I'll be able to just draw somewhere like this, like that. This can be maybe I can do it like that, sorry, like that. Yes, this is Dow Jones transportation average there. Right here indicates right this point here indicates sell signal, and here as well sell signal, like that. Meaning what? Meaning that investors have an indication that the market is actually going to start moving down. That is what you need to understand. That this is a sell signal of where you sell the securities that you already have. Or if you're intending to purchase, you don't consider purchasing the security at that moment. But however, after a little while, after some period of time, remember this is time like that, after some time, what happens is that the Dow Jones Industrial Average and the Dow Jones Transportation Average provide an indication of when to buy and sell. At this point is where you should have a buy signal, right? That part over here, this part here, buy signal, buy signal, there. So these indicators provide some guide to investors as well as analysts when to buy securities and when to sell the securities. When to buy, you buy low, you sell high. You buy securities at a low price, at the lowest price possible, then you sell once the securities actually reached a very high price there. Now, the Dow Jones Industrial Average, there are times when you find that if the Dow Jones Industrial Average is moving down and the Dow Jones Transportation Average is moving up in the opposite direction, then there is no indication of any trend. So I need to probably highlight that in writing right here. So I can highlight that by saying that when the Dow Jones Industrial Average, or I can put it in full, I think the best thing is to put it in full like that. Dow Jones Industrial Average, Jones Industrial Average, DJIA, is rising, and the Dow Jones transportation average is falling, rising, falling. There is no trend that exists there. So we are saying if you have a hypothetical graph like this, you find the Dow Jones is falling like that, Dow Jones Industrial Average is falling, and the Dow Jones Transportation transportation average is rising like that, then there is no indication of a trend that exists there. So there you should not be able to infer anything, and you should be able to probably maybe hold on a bit so that the trend can be able to exist. However, when the DJIA and DJI, the Dow Jones Industrial Transportation Average, DJTA, are both rising, by the security or asset. When the contrary occurs, sell into brackets, do not buy the security or asset. There. This is just a simple summary of this diagram over here, like that. Now, having looked at the prediction of the market using the Dow theory, we can move on and look at the support and resistance levels. Support and resistance levels as used in technical analysis. Now here probably I move on to this other side so that I can be able to draw a very nice graph over here that can be able to explain to us the support and the resistance levels. And the graph that I will draw over here will be indicative of when we as analysts or investors should consider buying once we see or identify such a trend. So we can be able to draw it like so. That. Price, time, that. And we can draw just something like, say, that. Can probably put it something like that. And probably this should rise a bit like that. That. So for us to understand the support and resistance level, we just need to know, just from the terms like that, we know that the support level is down there because it supports and prevents any further downward pressure movement there. So this is the support level, and this is the resistance level. You can say the support level supports any further downward movement. Supports level supports any further downward movement in security prices and restricts movement beyond that point. there, restricts movement. So we're saying the support level, so in some, it exerts some downward pressure. It tries to prevent that further downward movement in security prices, and there, that is what we're saying is the support level. The resistance level is the opposite of this, and we can say that the resistance level prevents any further movement upwards of security prices, friends, any further movement of security prices beyond a specified level there. So that is the support resistance level explanation right there. Now, the support and resistance level can provide an indication of trends as well. So if we have, since we're doing support and resistance level, I can use this space over here. If we have support and resistance levels moving like that, we can be able to say that this is a channel moving upwards there like that. And if we have support and resistance levels now, of course, moving like that, then we can see that that is in fact, a wedge. What you're saying is a wedge like that. So the prices are moving very erratic at the initial stages, but now as they come down to the most recent prices, it actually concentrates at one point there. So that's an indication that the security prices are actually moving down there. Now with that, we move on to now the chart patterns. With the understanding that we have done under support and resistance levels, we try and identify which chart patterns can be used to try and identify trends as used by technicians there. So we can have something right here. Chart patterns and the interpretation. Yeah. Chart patterns and interpretation, what we will be able to look at, we will first of all indicate a no trend, a bullish trend, and a bearish trend. That's what we need to understand. We may be repeating some of the items we've looked at, but that is what the technicians actually want us to do. They want us to understand what the principles behind the use of graphs and charts there. So we can have that and that here. So we can indicate that this is a no trend, a no trend there. And then B is a bullish trend. We can be able to draw how a bullish trend looks like. Right, just below that, we just draw a bullish trend. This is prices, time, like that. Prices, time. So we have now the same, rather, apologies, this is bullish trend. So we expect something like that. And then we can draw B, bullish trend. There. C, we can say bearish trend, which is moving down. So we can just draw the graph right over here. Bearish trend. This is prices against time. So now we can draw something like that, where we have the security price or asset price moving down like that. So this is C, bearish trend. Bearish trend. Now, once we've looked at those trends like that, here we cannot be able to interpret. Remember, it is chart patterns and interpretation. So here we cannot be able to have any interpretation. The interpretation here is a bullish trend, so we should be able to buy. Right over here, buy is the interpretation. Over here, sell, sell or do not buy. Do not buy is the interpretation right there. We can also move ahead and look at configuration or confirmation of a bullish trend. We can use now another graph here to just continue from this. Confirmation of a bullish trend, confirmation of a bearish trend, and no confirmation of a trend there. There, I can use that. I can still draw another one down here, so that all that will be left is for me to just indicate the trend there. So D, confirmation of can say confirmation of a bullish trend. Bullish trend. So we have something that moves like that. Then we have like that. And then it moves up in that direction over here. So these are the security prices over here. The security price is moving like that. Then we have that kind of a channel where there is no trend, and then it moves up in that direction. That is confirmation of a bullish trend. Then E here is confirmation of a bearish trend. Bearish trend. Where we are saying it was moving like this, then we have the channel existing like that, and then it moves back down in that direction there. Confirmation of a bearish trend. Yeah. Now, since we've already indicated a no trend over there, there is no need to try and draw a graph that indicates confirmation of a no trend. All we need to move on and look at is the reversal of a bullish trend, the reversal of a bearish trend. So let's look at how they look like. Here, have this graph drawn properly. Draw another one right here, just below it. That. This is price. Not indicated on these other ones over here. This is price still against time. This is also price against time. It's always good. As an analyst, you need to also always be complete in terms of whatever you're doing. Whether it's doing corporate finance, you're supposed to always be complete and incisive. So now we are just trying to see, now that is E, this is F, and we are saying confirmation of a reversal rather. We're looking at reversals. We've already done the confirmations. Reversal, sorry, of a bullish trend. So we have the security price moving down like that. We have no trend existing at that point, and then we find that the security price starts moving in that direction like that. So that is reversal of a bullish trend. It was moving down, then we had a no trend market right over here, and then it changed direction and said moving up like that. Now reversal of reversal of a bearish trend. Now this one will have a reversal of a bearish trend. EF, this is G, reversal of this is bullish trend, this is bearish trend. Bearish trend. So that means it's going to move the opposite like that. So security prices was moving like that, We had the channel existing or no trend existing there, then it came back and went back down like that. Reversal of it should be the other way around. Reversal of a bullish trend. Bullish means moving up. This is reversal of a bearish trend. Bearish, apologies. This is bearish. Bearish trend. This is reversal of a bullish. This is moving up, is always bullish, then it comes down like that. This is reversal of a bullish trend like that. So this is price, this is time. There. Moving on, we have a wedge. A wedge. And a wedge looks like so. This is still price. This is time. Now you have the security prices moving like so. You have the security prices moving like so, where you'll have it moving, narrowing down towards a point. Have it move in that direction over there as a wedge. Remember, a wedge is something that looks almost like that. So we find security prices being very erratic over here, but now concentrating towards a point there. That is what you're saying is my wedge. That's G, this is H, wedge. Now here we are saying that, especially when it's like this, we are saying that even if it is bearish like that, the security prices become less and less erratic over here. The interpretation can be that the security now is being less traded, is not being traded as much as possible. So that is what you're saying is a wedge there. Now, having looked at the chart patterns, now let's look at something else, and we look at reversal patterns there. So reversal patterns. Reversal patterns, apologies. Patterns. Now, under reversal patterns, what we have, we look at head and shoulders. And shoulder patterns. There. Just use a graph here. So the head and shoulders will just be like that. Then you have, this is price, time, there. So you find these represent the head, the shoulders, sorry, shoulders. These ones, and this represents the head. So it can be an indication of either a downtrend, or it can be an indication of a head of an uptrend, especially more so when you have the inverse head and shoulder patterns. So the inverse head and shoulder patterns will indicate an uptrend there. we can say inverse, head and shoulder, inverse head and shoulder. So inverse head and shoulders, just very quickly. It's just the opposite of that. So you have like that. This is now these are the shoulders, and that is the head, like that. So you can see that this is the pattern is moving like that. So this one is going to be a bearish trend, or it's almost going to be a reversal. And what we had looked at before, reversal, so it's actually a downtrend, then it changed back, it moved and back up like that. Next one is a double top formation. Double top formation. Over here, what we can do, right in a problem, maybe a very not so big diagram here. This is price, time, price, time, like that. So double top formation, if you have a line like that, in that form, so you find the security prices, let me put it like so. So you find the security prices moving like that, then it has like that. You can be able to now demonstrate that here is actually a double top formation like that. So it's double top at the top like that. So we're saying over here essentially we have the support component existing right there, so it can be able to just reinforce your decision that is going to be an uptrend there. So that's a double top formation there. Now to conclude this lesson, let's look at very briefly the trend lines. The trend lines are not any new to us right now in this topic review, because we've already looked at the Dow Jones Transportation Average and the Dow Jones Industrial Average. So let's very quickly look at trend lines. Trend lines there. So for trend lines, we just have the following. We just need to understand what each trend line indicates in terms of uptrends, downtrends, and like that. So if you find security prices moving like that, and the general trend line is moving like that, in the Dow Jones Industrial Average moving like that direction, that is a bullish trend, buy trend. That's when you're supposed to buy. Then if it's moving in the opposite direction, you can put it on that graph like that, and we're saying that the trend line is moving in that direction, and we say it is bearish trend, sell, security like that. Here we still have prices, and here we have time. That shows continuity in the line there. Having looked at the trend lines, now we can also try and have something like that. There is no indication of any trend line or any direction of the movement in security prices there. So what can we infer from that? We can infer nothing from that particular line. This particular line over here, we cannot be able to infer anything because there's nothing, there's no movement in any particular direction, either up or down. Having looked at that, we hope that you have enjoyed this lesson. We hope as well that you will be able to join us in our next lesson, where we will still continue looking at technical analysis. Thank you and God bless you.
Welcome to our another lesson on Introduction to Microsoft Excel. In our previous lesson, we started on working on how to work with basic formulas and functions in Excel. We looked at the formulas, among them addition, we looked at subtraction, we looked at division, we looked at multiplication, and we also looked at power in cells. So these are the formulas that we looked at last time that we had a lesson. Today, I want us to pick up from where we left and talk about more formulas about the same thing. We are going to talk about average. We are going also to talk about maximum. These are now statistical formulas. We are going to talk about minimum. How do you get the minimum value? We are going to talk about count. We are going to talk about mode. And we are also going to talk about some more formulas here. We are going to talk about standard deviation. Standard deviation, and maybe before I forget, there's also median that is to be done under the statistical formulas on basic formulas in Excel here. So this is what we want to cover, and it will be an extension of the work that you already have. Remember, we had this particular work that we used on our formulas last time. So this one is going to be an extension of what we already covered in our previous lesson. Let us begin by looking at average. So how do you get the average of some marks that you have with you? So average is operated the same way as what we did in the other formulas like addition and also getting the product. So you can average in cell, you can also be able to average in range. Let us start by averaging in cell. Of course, every formula is preceded with an equal sign, then average, then you double click on average, that will appear there. Then you can click on the cell that you want, or you can type it manually. So in our case, let us click on, we want to get the average of Tom. So I'll click on 65. Then now we separate them with commas. So 65, then comma, 84, then comma, 70, then comma, 76. And if that is the end, you close the bracket, shift and the sign of closing the bracket on the keyboard. After that, you enter. And it will give you the average for Tom for all the units as 73.5. So this is the average, and you can be able to copy it down all the way to the last one, which is not Juliet. I believe there is something wrong there. On our product in our previous class, I believe we might have included wrong items. Let me just confirm what we did. Okay, that seems to be okay. It's all fine. So up to the last one, who is Tony. So we've gotten the average of Tom all the way to the average of Tony. I can undo, and I can start again by getting the average. Of course, equal sign, then average. You double click on the average. Then after double clicking on the average, you can type manually like B10, you can see it's highlighted, comma, C10, comma, but that is a long way. If you want to move faster, you just click on them. So 65, comma on the keyboard, 84, comma, 70, comma. Remember, if you want to jump one, you can always jump. Assuming that you never wanted the one for auditing, you can always jump and you click on the last one. So this one is now excluded in your average for that particular period, and you can see the average has reduced. So there's also another way, of course, average in range. So again, average, and you just select average in range. You select up to where you want, up to 76, then shift and you close the bracket. So that is average in range. Then you enter to get 73.5, from which you can be able to drag down your formula all the way to what you want, up to Tony, and you'll get all your averages for that particular student. You can also get average here, if you so wish, average and equal sign, Or let us use now the other aspects. You can go to the formula place, AutoSum. If you see average, you click on average. There is average here, but this one will pick everything. You can see up to the next place where there is nothing. So this one majorly picks everything, but you can be able to highlight up to where you want, that is up to 20, and it will give you everything that you want. If you enter, of course the average is 66.60. You can undo, and again in the formulas you can use the insert function. You click on insert function. What do you want? You want average. Like that. So go, and you will see average highlighted here. Just click on it. Okay. Then you confirm whether B17 to B19 is what you want. B17 is just 15 subtraction, then B19 is just this one. So it's wrong. It means you can deduct, or you can do away with it and select whatever you want to get the average of. So you just select. You can see it is moving all the way to 20, and your average is set. So the average is set. Once you have done the correct thing, you click on OK, and you can see the answer is still 66.6. So whichever approach you use, of course the average is still going to be the same as in any other case. Average, you can see the answer is still 66.6. So you then drag across all the way to MA, so that you can have your average up to MA. So that is the average of those particular items. Having done the average, the next thing is maximum. Now we want to do maximum. What is the maximum? Maximum is the same as highest. So we are looking for the highest value in our set of data under financial accounting. So equal sign, then max. So you look for the function of max. This one returns the largest value in a set of values, and it ignores values and logical values and texts. Of course, this one is max. Then which one is the highest value? The highest value up to there. Then you close the bracket. This one gives you 88. So you can see in this set of data up to here, 88 is the highest value which has been returned by this. So if you copy across, it also gives you the other highest values in, like in this case is 84. In this case you can see it's 70 is the highest value here. In this case the highest value can clearly be seen to be 76, of course. So that is highest value using max. What about lowest value? How do you get the lowest value? Of course, when using the lowest value or getting the lowest value, you use mean. So we are going to use mean to be able to get the lowest value. And again, you highlight all the way to this one, and the lowest value there is that one. So the lowest value is 50. The formula is saying that it's 50. Let us see. The lowest value, indeed, 50. Here there is nothing, so it cannot count that. So 50 is the lowest value. There are two 50s, so it will just pick any. What about these other cases? You can drag across and get your lowest value. Again, here they are saying it's 50. Let us confirm. The lowest value is indeed 50 from this set of data. It's 50. What about 34 here? Is the lowest value 34? Indeed, yes. The lowest value is 34 from this set of data. Even here, of course, the lowest value is 24 from this set of data. It is 24. So that is the lowest. If you want to get the lowest value using minimum. Now we want to move to median. How do you get the middle value? Middle value, of course, we'll be using median. Equal sign, then we do median. So we double click on the median, and you can be able to get the lowest value in that set of data, median. And that is median. Is it the median? Of course, when getting the median, Excel arranges from the lowest to the largest and then accesses the median value. So if you arrange these items from the lowest to the largest, the median value will be 65. So let us copy across and see which is the median value in the other cases. You can see the median value in these other cases here. So that is median, which helps us to get the middle value or the midpoint. So after the median value, we can also be able to get mod. Mod simply refers to the most occurring. So most occurring, that is mod. Most occurring. So let us see, how do you get the most occurring in mod? You can see mod, the function is available for this one returns the most frequent occurring or repetitive value in any array or range of data. So this one returns the most occurring. So again, we want to select here and get the most occurring in a set of data. And the most occurring that set of data is 50. Let us see if 50 is most occurring from here to here. Yes, 50 occurs twice. So 50 is the most occurring. If you copy across, you can see that it gives you 50 again here. And indeed, 50 is the most occurring, 50 and 50. But here, the answer is not available. That means there is no most occurring. So there is no most occurring here. There is no figure that is repeating itself in this set of data. So there is no most occurring. Even here, there is no figure that appears more than once. So there is no most occurring in this set of data. So that's why the answer here is not available. And indeed, that is the correct answer, not available. After that, you move to another formula. After most occurring, which is mod, we can be able to get the standard deviation. Standard deviation. Of course, standard deviation is equal sign, then STDEV. That is the formula that you use for standard deviation. What is standard deviation? You can see it says estimates the standard deviation based on the sample. It ignores the logical values and text in the sample. So that we want to get the standard deviation of this set of data from here moving the way to this place. Then you close the bracket and this will give you a B10 to B15. If you enter, it returns the standard deviation as what you can see there. So that is the standard deviation. If you copy across, it gives you the other standard deviations from the other set of data there. So those are the other statistical formulas, basic of course for beginners, that you can be able to use in your work. You can be able to use to manage your work, either if you are a student or if you are working somewhere. These are the functions that are usually used when doing a lot of statistical and also mathematical tasks. There's an Excel file that is attached below the video description, which will use for your assignment. So make sure that you go through it and redo almost everything that you've done, almost everything that we've gone through in this particular lesson. Thank you, and see you in our next lesson.
Hi candidate, welcome to another session of Manifested Online Classes. So in this session, I want us we continue with the topic number 1, and specifically I want us we look on the subtopic of deferred tax. So this, first of all, is an extension of what you covered in financial reporting and analysis, intermediate level, where you did something to do with the accounting for current taxes and also accounting for deferred tax. So at the advanced level, you need only to cover the concept of deferred tax, but at the advanced level, also the examiner will test the concept of group account. For example, you need to know how to compute things like the unreleased profit and so on, because the examiner may give you some goods which were maybe sold by the parent company to the subsidiary, and you're told some of the goods were not yet sold at the end of the year. So basically, you have to be able to determine the cost of those particular goods. And for you to do that, you must be in a position to determine the unreleased profit. So therefore, at this level, you just need to cover the concept of deferred tax, but now with a group with a group aspect. Now, I want us to look on some few illustration questions, but before you do that, I want us to look on a quick recap of basically what you need to know as far as the deferred tax is concerned, so that we can be able, we can be on the same page. So first of all, a deferred tax Basically, we say this is a provision created by the company during the current financial year for a tax which is supposed to be paid by the company in the future, or a tax which is supposed to be recovered by the company in what? In the future. So equally, when computing for the deferred tax or determining the amount of deferred tax which is to be provided for in the income statement, we have two approaches which may be used by an entity. Number one, we have the income statement approach, whereby the deferred tax to be charged in the income statement, to be taken into account in the income statement, is computed using something called the timing difference. The timing difference is the difference between the accounting profit and taxable profit, and which give rise to deferred tax. But now, International Accounting Standard number 12 do not do not prefer entities to use that particular method. And therefore, the other method which is recommended by IS 12 is the balance sheet method, whereby the deferred tax is computed based on something called the temporary difference, based on something known as the temporary difference. So what is a temporary difference? A temporary difference basically is the difference between carrying amount and the tax base of the asset and what? Liability. So, of which in this case we have two types of deferred temporary difference. We have the taxable temporary difference and also the deductible temporary difference. Maybe we can just start our recap there. We say that deferred tax, this one, according to the balance sheet, maybe you can just say according to a balance sheet or statement of financial position approach, and which you have said is a method which is recommended by International Accounting Standard number 12. According to balance sheet or statement of financial position approach, deferred tax is computed using temporary difference. Which is abbreviated as TD. And what is a temporary difference? A temporary difference, this is the difference between the tax base and the carrying amount of asset and liabilities. So temporary difference, which is abbreviated as TD, is the difference between the carrying amount, which is abbreviated by CA, and the tax base. So when talk about the carrying amount, we have to recall what you covered in the lower level. Carrying amount is the value at which an asset or even a liability is recorded in the company's statement of financial position. For example, when talk about the carrying amount of PP, we are talking of the net book value. So on the other hand, when talk about the tax base of asset and liabilities, this is the value of an asset or liability for tax purpose. For instance, equally when talk about the tax base of the PP, we are talking of the written down value. Written down value which is computed by taking the cost of the PP minus the total capital allowance, or minus the total wear and tear allowance. So that is the first thing you need to recall, that what is carrying amount and also what is tax base. Now in this case, this temporary difference can either be taxable temporary difference, or deductible temporary difference. Taxable temporary difference, abbreviated as TTD. Deductible temporary difference, abbreviated as DTD. So a temporary difference is taxable whereby the carrying amount of asset or liabilities exceed the tax base. But on the other hand, if the carrying amount of an asset or liability is less than the tax base, then you get something called a deductible temporary difference. Now, a taxable temporary difference, this one gives rise to something called a deferred tax liability. Deferred tax liability, abbreviated as DTL. And therefore, to compute the deferred tax liability, we take the taxable temporary difference times the tax rate. Abbreviated by TR. So this taxable temporary difference times what? Times the tax rate. But on the other hand, a deductible temporary difference, this one gives rise to something called the deferred tax asset. A deferred tax asset is a tax which is recoverable by the company in the future, deductible temporary or deferred tax liability is a tax payable by the company in what? In the future. So how do we therefore compute these deferred tax asset? To compute the deferred tax asset, we take the deductible temporary difference, DTD, equally times what? Times the tax rate. Times what? The tax rate. So therefore, this is the first thing you need to recall from basically what you covered in financial reporting and analysis intermediate level. And I think with that particular small recap, we can be able to proceed and look on a question from a past paper. And basically, this is a question which was tested in the sitting of August 2022. And specifically, it is question number 2B. So we go through the question, we see what we are told, and it reads, T Limited, a public limited entity, is a holding company in a group of companies. The following transactions related to deferred tax or the foreign transactions relating to deferred tax were extracted from, for the purpose of finalizing a group financial statement for the year ended 30th April 2022. Number one, you're told T Limited own property, plant and equipment that cost shillings 625 million when purchased. Depreciation of shillings 250 million has been charged up to the reporting date of 30th April 2022. The entity has claimed a total capital allowance on property, plant and equipment of shillings 300 million. And then you're told on 30th April 2022, the property, plant and equipment was revalued at shillings 575 million. Number two, we are told on 31st of October 2021, the company completed a development project and incurred a cost of 200 million, which it capitalized in accordance with IS 38. The estimated economic useful life of the intangible asset was 5 years at 31st of October 2021. Then you're told the company obtains a full tax relief for research and development expenditure on cash paid basis. Number three, we are told during the year which ended 30th April 2022, T Limited transferred goods worth shillings 1,500 million to one of its subsidiaries. T Limited made a gross profit margin of 20% on its sales. And then you're told a third of these goods remained unsold by the subsidiary at the reporting date of 30th April 2022. And then number four, we are told the trade receivables were carried in the consolidated statement of financial position at shilling 480 million. This was after allowance for doubtful debts of shilling 60 million and unrealized foreign exchange gain of shillings 80 million. The allowance for doubtful debt and the foreign exchange gain stroke losses are only allowed for tax purpose when realized. And then you're told number five, the balance on the deferred tax liability account of T Limited as at 1st May of 2021 was shillings 25 million. And then number six, we are told the income tax rate applicable to T Limited for the year which ended 30th of April 2022 was 30%. So what are we required to do? Roman 1, compute the relevant temporary difference as at 30th April 2022. And Roman 2, we are required to prepare a deferred tax account. So basically, this is a question for deferred tax. But as you can see from the information which is provided here, this is information relating to a group of companies. That's why we are saying at this level, the questions which will be tested for deferred tax, they do have the aspect of the group. The aspect of what? Of the group. So let's start with Roman 1 of that particular question, whereby the examiner was requiring the candidate to compute the relevant temporary differences. So how do we prepare these temporary differences? We need to prepare something called a schedule of temporary differences, a schedule of TD, temporary differences. So in this schedule, we need to have a number of columns. So the first column here will be for the various items of asset and liabilities which are provided. And then the next column here will be for something called the carrying amount. carrying amount abbreviated as CA. We have another column here for tax base, tax base, and the last column here for the difference between the tax base and the carrying amount, which is the temporary difference. Also, if you check on the figures which are we are given in that particular question, those figures are in million of shillings. So we need to indicate that our figures here will be in million of shillings, in million of shillings, like that. Yes, so what we need to do, let's start with the information which is given in note 1. And in note number 1, we are given information about PP. So therefore, what we do, we first of all record that item here. We are given the item of PP, property, plant, and equipment. And you're told that the cost of this property, plant, and equipment was 625 million when it was purchased by the company. And then you're told it has been depreciated, or the depreciation which was charged as at 30th April of 2022 was 250 million. In other terms, this is the accumulated depreciation as at that date. And then you're told the entity has claimed a total capital allowance on property, plant, and equipment of 300 million. And then you're told at the end of the current year, this particular property, plant, and equipment were revalued at an amount of how much? 575. Now, as far as the PP is concerned, we are given three values there, or basically we can be able to determine three values. Number one, we can be able to determine the net book value of this PP, which will be equal to the cost minus accumulated depreciation. So the costs of this particular property, plant, and equipment is 625 million, and you're given the accumulated depreciation of 250 million. So we need to get the net book value. Remember, the net book value is the same with the carrying amount, or basically, yes, this will be the same with the carrying amount, and then also we are given the revalued amount. We are told these items of PP were revalued at the end of the current year at an amount of 575 million. And also from the information which you are given in that question, we can be able to get something, or to compute something called the written down value. The written down value, this one is equal to the cost minus the total capital allowances which have been claimed by the company. So we know the cost is 625 million, and then the total capital allowances claimed by this company is 300 million. So this will give us 325 million. So this 325 million, maybe to start with that, that is what if as the carrying, not the carrying ladder, this is the tax base. This is the tax what? The tax base. So the value of an asset, or basically those particular assets which qualify for capital allowance, their value for tax purpose is always equal to the written down value, which is equal to the cost minus the capital what? Allowances. So therefore 325, that is basically the tax base. Remember, the tax base is the value of an asset or liability for tax what? Purpose. So therefore, the value of these items of PP for tax purpose is written down value. What about the carrying amount? Now, for carrying amount, here we have two values. We have the net book value and the revalued amount. Now, a question arises here. Whenever the company has revalued the asset at the end of the year, those particular assets in the statement of financial position, are they supposed to be recorded there at net book value? Are they supposed to be recorded there at the revalued amount? So automatically, anytime the company revalue the asset, those assets are recorded in the statement of financial position at the revalued amount, not at the net book what? Value. So therefore, the carrying amount, which is the value at which these particular items of PP will be recorded in the statement of financial position, is what? 525. So, and then what we need to do is basically to get the difference there. The difference, or the temporary difference, this is equal to this minus that, which will give us 250. And because it's a positive figure, we refer to that as taxable temporary difference. If you get a negative figure, it is a deductible temporary difference. But it's also important to note that from the information which are given here, you can see these items of PP were revalued to 575. But in this case, we have the carrying amount, or basically the net book value, I think, which we needed to compute here. So this will give us 375. So that was the net book value of these items, but they were revalued to an amount of how much? 575. Automatically, what that means is that there was a revaluation gain equal to the revalued amount, 575 million, minus the net book value, 375, and basically this should give us 200 million. So 200 million, this is a revaluation gain. And according to IAS 12, anytime the company revalue items of PPE, and that give rise to a revaluation gain, then the entity should do what? Determine something called the deferred tax expense. So how is this deferred tax expense accounted for? We take the revaluation gain times the tax rate. So the revaluation gain in our case is 200 million. And then the tax rate, as per, we are given the tax rate in the additional information number 6, 30%. So this will give us 60 million. So how is this deferred tax accounted for? The deferred tax expense accounted for. This deferred tax is accounted for by debiting the account called the revaluation reserve account, and then we credit an account called the deferred tax account. So when answering, or basically when preparing the deferred tax account as required in Roman 2 of that question, that is the moment you're going to take into account that particular word, deferred tax expense. That deferred tax expense will be credited in that account. But what we need here is the carrying amount and also the tax base. So let's move to point number 2 here. And in point number 2, we are given information about the development project which was undertaken by this company, where we are told the company incurred a cost of 200 million and capitalized that cost in accordance with IS 38. So anytime the company is, for example, developing a certain product and so on, and the company has incurred some development cost, that development cost should be capitalized. In other terms, it should be treated as an asset. Now, in this case, what we need to do is to determine the carrying amount and also the tax base. Now, the carrying amount, or basically the amount at which this particular development cost will be recorded in the company statement of financial position, is always equal to the cost. So the carrying amount of this development cost is equal to the cost. This is the carrying amount is equal to the cost minus the accumulated amortization. Amortization is the amount which has been written off. So we know the cost is 200 million. And then in this case, we are told that this particular development project was completed on 31st of October 2021, meaning that this 200 million, it was capitalized from that date. Or in other terms, it was treated as an asset from 31st of October 2022. But in our case, we also know that the current year is ending on 30th of April 2022. We are told this cost was capitalized from 31st of October 2021. So how many months do we have here? So we have November, December, January, February, March, April. 1, 2, 3, 4, 5, 6. So mean that we have 6 months. Or basically this development cost was capitalized 6 months now to the end of the year. And the reason why that is important is because the amortization we are going to deduct from this particular cost will not be for the whole year, but rather it will only be for 6 months. So therefore, what we do to compute the amortization, we take the cost, which was capitalized 200 million, we divide that with the estimated useful life of this asset, which are 5 years, and then this will give us amortization for the whole year, but in our case, we are only interested with amortization for just 6 months. So this will give us 40, and then half of that is 20. So this will give us 180M. 180M is the carrying amount. What about the tax base? Tax base, in this case, is equal to the amount which will be allowed for tax purpose in the future. There is some information which you are told in this question that the company incurred this particular development cost during the current year, or basically before the end of the year, 6 months to the end of the year. And then in the last sentence, we are told the company obtained a full tax relief of research and development expenditure on cash paid basis, meaning that anytime the company has incurred development cost or even the research cost, that amount will be treated as an allowable expense once it has been paid. Once it has been what? Paid. So mean that this development cost has already been paid. Then the tax base, in this case we are saying, will be the amount which will be treated as an allowable expense in the future. And take into account the full amount has already been treated as an allowable expense. So the amount which will be treated as an allowable expense in the future will be what? 0. So therefore that is the tax base. So we get the difference here, which is 180, still a positive, and that is a taxable temporary difference. So let's move to point number 3. Where we are given some information. We are told during the year which ended 30th of April 2022, T Limited transferred some goods worth 1,500 million to one of its subsidiary, and then you're told T Limited made a gross profit margin of 20% on its what? Sales, on its sales. And then you're told a third of these goods remained unsold by the subsidiary at the reporting date. Now, from that particular point, what we are, our interest is the inventory. Basically, what we know is that, or what you are told is that the parent company, which is T, sold some goods now to the subsidiary, and basically some of those particular goods had not been sold to third parties. So meaning that some of the goods remained in the inventory or were part of the closing inventory of the subsidiary. That is our interest here. How much goods were not yet sold by the subsidiary at the end of the year? And in this case, we can be able to determine their value because here we are told the goods which were transferred by the parent to the subsidiary, they had a value of 1,500 million, but now the goods not yet sold at the end of the year, we are told they were a third. A third of that is what? Is 500 million. So this particular 500 million is basically the cost to this company. Is the cost to this what? To this company. But now what we know is that this particular goods have an element of unrealized profit. Have an element of unrealized what? Profit. So what we need to do is basically we take 500 million, we less the unrealized profit. How do we less the unrealized profit? The unrealized profit, this one is computed by taking the unsold goods, the unsold goods 500 million, 500 million times the gross profit margin. That is how we compute the unrealized profit from what you have covered in the topic of group accounts. So what we do, we take 500 million minus the unrealized profit, which will be equal to unsold goods 500 million times the gross profit margin. The gross profit margin in our case we are told is 20%. So this will give us 100. So 100 million. So therefore, this will give us for what? This will give us for 400 million. 400 what? Million. So this particular 400 million is basically the cost. Is the cost. And basically what we know is that anytime a company is preparing, or even a group of companies preparing the consolidated statement of financial position, the inventory should be recorded there, mostly at the level of the net realizable value and the cost. So we know the selling price is 500 million, but the cost is what? Is 400 million. So therefore, this particular goods here will be recorded in the statement of financial position at what? At that particular amount which you have computed there. So therefore, in our case, we have the tax base, which is now 500 million. But we have said in the statement of financial position, this particular inventory will be stated there at what? At the cost, which is 400 million. And basically, we get the difference, this minus this, which will give us 100 million. And because it's a negative, that is a deductible temporary difference. Deductible temporary difference. So we are through with point number 3. Let's move to point number 4, where we have information about the trade receivables. The trade receivables. So for the trade receivables, we are already given the carrying amount. The amount at which the receivables are carried is the statement of financial position. No problem with that. Which is 480. But we are told this figure was arrived at by this group of companies after making allowance for doubtful debt of 60 million and including unrealized foreign exchange gain of what? Of 80 million. Now, for you to be able to know how to determine the tax base of the trade receivables is always equal to the gross amount, because now what you are given here for 80 is the net amount. So this net amount of 480 is arrived at by the company after having deducted a provision for doubtful debt of 60 million, and also after including 80 million, which is unrealized, unrealized foreign exchange gain, unrealized forex what? Forex gain. So this unrealized forex gain is like an accrued income. It has been added in arriving at the figure of 480. So how do we get the gross amount? Because you are saying this is a net. Whatever you have here is a net. And we are saying that the tax base of receivables is always equal to the gross amount. So the gross amount in this case will be equal to 480. And then we add what has been deducted, 60, and then we less 80, which has been what? Added there. So that is how we arrive at the gross amount, which you are saying is what? Is the tax base. So this is like 480, and then we deduct 20, which will give us 460. So 460 in our case is what? Is the tax base, Yes, so I think we are done with that point. And then in point number 5, we are given the deferred tax liability at the start of the year, which we are going to use in Roman 2, and also in part 6, number 6, we are given the tax rate. So tax rate, basically, we are going to use it here. So therefore, what we need to do, we get the difference, this minus this, which will give us 20, a positive, and is a positive, so mean that is a taxable temporary difference. So take into account we don't have anything else or any other item of asset or liability which you are provided with. So what we need to do is basically to get the net amount here. So we add all that. We see what it will give us. So we have what? We have 250 plus 180 will give us 350, which is a positive figure, and we refer to this as net taxable temporary difference. Difference. So that is it, that what was required in part A of that particular question. And basically by doing that, the marks allocated there were 6. And generally what is marked in such a question are these figures here. These are the figures which are marked. Basically by doing that, a candidate was supposed to get 6 marks. So let's move to Roman 2 of the question. And in Roman 2, we are required to prepare the deferred tax account. Deferred tax account. Deferred tax account. So this one is basically quite simple because what we first of all record here is the deferred tax asset or deferred tax liability at the start of the year. And if we go back to the information we have in note number 5, we are told the balance on the deferred tax liability account of this group at the start of the year was 25 million. So I hope you can see we are told that is a deferred tax liability. So, and because it's a deferred tax liability, we record it as the opening balance in this account. On which side? On the credit side, because we know all liabilities have an opening credit balance. So the balance brought down is 125 million. There is also something else we also need to remember here. Okay, before we record this item here, remember there is an item which we said will be recorded in this account here, this one. So before we record that item, so first of all, we need to determine the amount of deferred tax at the end of the year. And take into account at the end of the year, there was a net taxable temporary difference. You have to recall what we said here. that a taxable temporary difference give rise to something called a deferred tax liability. So what we need to do is to compute the amount of deferred tax liability at the end of the year, which is computed by taking the taxable temporary difference, which is 350 million. We multiply that with what? With the tax rate. Tax rate we know is 30%. So this will give us now the deferred tax liability at the end of the year. So we have 350 times 30%, and that will give us 105 million. 105 million. So this is the deferred tax liability at the end of the year, and such deferred tax liability at the end of the year, we record it on the debit side of this account, but down here. So the deferred tax liability at the end of the year is 105 million. So the other item which we need to record is what we have here, the deferred tax expense on revaluation gain, which we said in the deferred tax account will be that will be what? Credited. So we have the deferred tax expense, on a revaluation gain, which is computed as a figure of 60 million. And then from there, what we need to do is we balance our account. We balance our account, of which now the balancing figure in this account is the amount now which will be taken to the income statement. Is either deferred tax income or a deferred tax expense. I think what we have on the debit side is more 105 million. 105 million. So mean that we're going to have a balancing figure on which side? On the credit side, which will be equal to 25 plus 60. Basically 85. We deduct that from 105. 105, which will give us 20 million, and this will be taken to income statement, of which a balancing figure on this side, this one is known as a deferred tax expense. A deferred tax expense. But if the balancing figure was on this side, still we take it to the income statement and we refer to that as deferred tax income. We refer to any balancing figure on this side as a deferred tax income, deferred tax income. And basically that is it. That's what was required in that part. And the marks allocated here were 4 marks. So the items now which were marked, or the items which were marked are those 4 items. Opening balance, this deferred tax expense on the revaluation gain, the amount of deferred tax expense to be taken to the income statement, and this figure. So a candidate in that case was supposed to get to how many marks? 4 marks. So basically that is it. That what was required as far as that illustration is concerned. So once we come back in our next session, still I want us to look on another illustration from the same topic.
Hello and welcome back to the lesson. The subject is Advanced Auditing and Assurance. Today we are going to study the subtopic Subsequent Events. Then we will consider the audit work that is done between the financial year end and date of signing the financial statements. But first of all, we're going to define subsequent events. Then we'll give a few examples of subsequent events so that you can be able to understand the meaning of subsequent events. Now, candidates, what are subsequent events? Subsequent events are events or transactions that occur after the financial year end, but before the date when the financial statements are authorized or issued. So assuming the financial year ends on 31st of December and the financial statements are authorized and issued, say, in 30th of January, So the time that lapses, or the events that takes place between the date of signing financial statements and the financial year end, the events that occur, the transactions that take place between that time are what we are referring to as subsequent events. And such events can have a significant impact on the entity's financial position. It can have significant impact on results of operations as well as disclosures. And there are two main types of subsequent events. There are types of subsequent events that can be classified, let me say, into two categories. We have what we call recognized subsequent events, recognized subsequent events. That's the first category. Then there is the unrecognized subsequent events. But let's first of all define recognized subsequent events. Now, what are recognized subsequent events? These are events that provide additional evidence about conditions that existed at the financial year end. Remember, we've said that subsequent events are transactions or events that take place between the financial year end and the date of signing the financial statements. I repeat, subsequent events refer to events or transactions that occur after the financial year end, but before the date of signing the financial statements. And there are two main categories of subsequent events. The first one is recognized subsequent events. Recognized subsequent events are those that provide additional evidence. They provide additional evidence. These are events that provide additional evidence about conditions that existed at the financial year end, all right? And require adjustments to the financial statements. And they require adjustments to the financial statements. So, number one, recognize subsequent events. These are events that happen between the year end, and the date of signing the financial statements. Another feature about these events is that they provide additional evidence about the position, about the conditions that existed at the financial year end. And then they require adjustments to the financial statements. In other words, these events affect the financial statements recognition, measurement, and disclosure. They affect the financial statements. These events affect the financial statements. Now, to make you understand clearly, I'll give a few examples of recognized subsequent events. One obvious example is a settlement of litigation. Settlement of litigation. If a lawsuit or legal dispute is settled after the financial year end, then the settlement amount may need to be recognized and reflected in the financial statements. So number one, this settlement of litigation happened after the financial year end. Do you understand? It happened after the financial year end. So we are saying such an example is an example of a recognized subsequent event, which you have said it affects the financial statements, it needs to be adjusted, and it provides additional evidence. And therefore it has to be reflected in the financials. An adjustment has to be made. If a legal dispute is settled after the financial statement, but before the date of signing financial statement, then that has to be reflected in the financial statements. Number two is purchase or sale of assets. Purchase or sale of assets. Now, if a significant acquisition or disposal of assets occurs after the financial year end, then adjustments may be necessary. Why? To properly reflect the impact on the financial statements. If assets are sold or purchased after the financial year end, but before the date of signing financial statements, that is a recognized subsequent event that require adjustments to the financial statements. 3, bankruptcy. Bankruptcy. If an entity files for bankruptcy after the financial year end, but before the date of signing financial statements, it may impact the valuation of assets. It may impact the recognition of liabilities. It may also impact the presentation and disclosure in the financial statements. So such an event has to be adjusted. It will impact the valuation of assets. So if it impacts the valuation of assets, then that has to be reflected in the financial statements before the date of signing the financial statements. It's a subsequent event. Bankruptcy. I'll give more examples. Changes in accounting estimates. Changes in accounting estimates. Changes in accounting estimates. If there are changes in estimates, such as impairment or provisions, after the financial year, then adjustments should be made to reflect the changes. Do you understand? If there are changes in estimates, accounting estimates, then that's a recognized subsequent event, and therefore adjustments has to be made to the financial statements to reflect the changes. So these are recognized. Number one, recognized subsequent event. I'll discuss here number two, non-recognized subsequent events. Non-recognized subsequent events. This is the opposite of recognized subsequent events. Okay? Non-recognized subsequent events are those events that provide information about conditions that arose after the financial year end. They provide evidence about information that arose after the financial year end. And therefore, these non-recognized subsequent events do not need adjustments, do not require adjustments to the financial statements. Instead, they may require disclosure in the footnotes of the financial statements to inform users about significant events or transactions. These are subsequent events that do not require adjustments. These are transactions events that do not require adjustments. I've said these events or transactions provide information about conditions that arose after. They provide information about conditions that arose after the financial year end. The recognized subsequent events provide additional evidence of conditions that existed before the financial year end. These ones provide information about conditions that arose after the financial year end. Do you get the difference? This is after the financial year end. This one is before the financial year end. Do you get the difference? Why adjustments are required when recognized subsequent events occur? Do you understand why adjustments are not required when non-recognized subsequent events occur? So let's now give examples. I'll give examples just the way I did in the case of recognized subsequent events. Examples to help you understand clearly is issuance, number one, issuance of debt or equity. A, issuance of debt or equity. Issuance of debt or equity. If a company issues new debt or issues new equity securities after the financial year end, it may not disclose, it may disclose to inform users about the subsequent financing activities. So here, non-subsequent event, no adjustments are necessary, but the company can make it as part of the disclosures to the financial statements. Does not require to adjust. Adjusting the financial statement is not necessary, but the company can disclose it as a footnote in the financial statement. 2, natural disasters. Natural disasters. If a natural disaster occurs, after the financial year end, it may not require adjustments to the financial statements, because a disaster is something that is not expected. It's not something that is expected. So you cannot say it provides evidence, additional evidence to the existing conditions. No. It does not provide evidence to the conditions that existed before the financial year end. Does not do that. And therefore, no adjustments are required. Do you understand? It may not require adjustments to the financial statements, but should be disclosed to provide information on the significant impact of the disaster on the entity's operations or financial position. It is a non-recognized subsequent event, a non-adjusting event. 3, significant business acquisition. Significant business acquisitions. If a company acquires another business after the financial year end, then the details of acquisition, such as the purchase price and the impact on the financial statements, may be disclosed. It is a non-recognized subsequent event. No adjustments are required, but such an event has to be disclosed as a footnote to the financial statements to help users understand the effect of such a purchase on the financial statements. Significant business acquisition. Number 4 is changes in regulations. Changes in regulations. If there are changes in regulations or changes in laws that affect the entity's operations or financial position after the financial year end, such changes may be disclosed to inform users of the financial statements. Just require disclosure. Do you understand? It is a non-recognized subsequent event, a non-adjusting event. It does not need to, it does not require adjustments. It only provides information about conditions that arose after the financial year end. Change in regulations is evidence of information that existed after the financial year end. But things like settlement of litigation after the financial year end will require adjustments. Why? It's because before the settlement of litigation, there was a dispute. So if settlement is made after the financial year end, but before the date of signing the financial statements, then this has to be adjusted. The financial statements must be adjusted. As the same as purchase or sale of assets. Adjustments are necessary. Bankruptcy, adjustments are necessary. Estimates, changes in accounting estimates, adjustments are necessary. So candidates, that's the meaning of subsequent events. I've defined subsequent events. I've identified the types of subsequent events, that is the recognized subsequent events and the non-recognized subsequent events. Do you understand the difference? Do you get the difference? So candidates, before we look at the audit work done between the financial year end and the date of signing the financial statements, it's important to note that management and auditors, it is important for management and auditors to evaluate subsequent events to determine their impact on the financial statements. Because recognized subsequent events we've seen require appropriate adjustments, while non-recognized subsequent events may necessitate additional disclosure to provide users with relevant and timely information. And this ensures that the financial statements reflect the most current and accurate information available at the date of issuance. When adjustments are made, then it means that information is accurate, information is current for the users. Now let's now discuss the audit work the audit work that should be done between the financial year end and the date of signing the financial statements. Now, candidates, between the financial year end and the date of signing the financial statements, auditors perform specific audit procedures related to subsequent events. And these procedures aim to gather evidence about events or transactions that occurred after the financial year end but before the date of signing the financial statements. So we're going to look at the procedures that the auditor has to carry out during this period. Audit work. Audit work done between the financial year end and the date of signing the financial statement. The first one is inquiry. Inquiry, and also what we call analytical procedures. And analytical procedures. Inquiry and analytical procedures. That's the first audit work. Now, auditors make inquiries of management and key personnel regarding any significant events or transactions that have occurred after the financial year end. Inquiries, asking questions of management, asking the key personnel questions. That's the meaning of inquiry. You ask the top management of any major events that may have occurred after the financial year end. Auditors may also perform analytical procedures. These are procedures to assess whether there are any unusual or unexpected fluctuations or relationships in the financial data that may indicate the occurrence of subsequent events. So the auditor may make inquiries from the management or can carry out analytical procedures using financial data. Okay? So that after carrying out analytical procedures, you can identify any unexpected fluctuations or any unexpected or unusual relationships in the financial data. That is the first audit work. Number two, review of subsequent events documentation. Review of subsequent events documentation. Reviewing subsequent events documentation. What are these documentations? This could be the minutes of board meetings. This could be the documentation in relation to management discussions or any other relevant records. So the auditors review the organization's subsequent event documentations, which include the minute of board meetings, the management discussions, and so on. And by reviewing these subsequent events documentation, this can help identify any material subsequent events that may have an impact on the financial statements. So candidates, after the financial year end, the auditor should carry out this procedure. The auditor should seek to review subsequent event documentation. And by subsequent events, we are talking about the events or transactions that takes place after the financial year end, but before the date of signing the financial statements. So between that period, if it's 1 month, then the auditor should check if there are any management discussions, if there are any board meetings. If there are any board meetings, then the auditor should review the board meetings, the minutes of the board meetings, so that he can find out if there are any subsequent events which may impact significantly the financial statements of the organization. If there are any material subsequent events, then that can come to the knowledge of the auditor by reviewing subsequent events documentations. Do you understand, candidates? Subsequent events documentation, there is no specific document known as subsequent event. No, these are the documentation that this is documentation in relation to events that takes place between the financial year end and the date of signing the financial statements, and that could be the minutes of board meetings and even minutes of management discussions and so on. That is a procedure, an audit procedure or audit work done between the financial year end and the date of signing the financial statements. 3, cut-off procedures. Cut-off procedures. Auditors perform what we call cut-off procedures to ensure that transactions and events are appropriately recorded in the correct accounting period. And auditors review documentation such as invoices, contracts, bank statements, and any other supporting documents in order to do what? To verify that the transactions are recorded in the correct financial year. So during this period, the auditor should carry out cut-off procedures so that the events that occur between the financial year end and the date of signing financial statements are events or transactions that relate to the financial year under consideration, so that the information is that relates to the financial year is recorded in the current financial year and not the subsequent financial year. Cut-off procedures. Number 4, evaluation of recognized subsequent events. Evaluation of recognized subsequent events is another audit work that can be carried out during this period. Evaluation of recognized subsequent events. Now, auditors here assess whether any recognized subsequent events require adjustments to the financial statements, and that involves evaluating the impact of the events on the financial statements and ensuring that the adjustments are appropriately reflected in the financial statements. Evaluation of recognized subsequent events. That's another audit procedure. 5, disclosure of non-recognized subsequent events. Disclosure of non-recognized subsequent events. Remember, we said that non-recognized subsequent events do not require adjustment, but these are events that must be disclosed in the financial statements under the footnotes. Auditors here determine whether any non-recognized subsequent events require disclosure in the financial statements, and that includes evaluating the materiality and the relevance of events and ensuring that appropriate disclosure are made in the financial statement footnotes. Six, updating risk assessment. This is yet another audit procedure, updating risk assessment. Auditors update their risk assessment and evaluate the impact of subsequent events on the assessed risks. And the auditors consider whether any new risks have emerged or whether the existing risks have changed as a result of the subsequent events. As a result of the subsequent events. Updating risk assessment. 7, management representations. Management representations. Here, auditors obtain written representations from management regarding subsequent events. And these representations confirm that management has disclosed all known subsequent events that are relevant to the financial statements and that appropriate adjustments and disclosures have been made. So the auditors must seek management representation letters from the management in relation to subsequent events. And in looking for or requiring or asking for these management letters, representation letters, the auditor must confirm that the management, number one, has disclosed all known subsequent events, and these are events that are relevant to the financial statements. And number two, appropriate adjustments have been made. And lastly, appropriate disclosures have been made. That is an audit procedure. That is the audit work done before the date of signing the financial statements. Then lastly is a review of events, This is review of events occurring after the date of the auditor's report. Review of events occurring after the date of the auditor's report. That is the audit procedure that has to be done. Review of events occurring after the date of the auditor's report. Auditors review any events or transactions occurring after the date of their report, but before the financial statements are issued. They assess whether there is need to update the auditor's report or include subsequent event disclosures. Do you understand? So these are the audit procedures that must be carried out before the date of signing the financial statements. And that is between the financial year end and the date of signing the financial statements. So that will mark the end of our today's lesson, where we've defined subsequent events. By now you should now be able to define subsequent events. We've also identified the types of subsequent events. We've said, first of all, that subsequent events are events or transactions that take place between the financial year end and the date of signing financial statements, we've categorized the subsequent events into two. That is the recognized subsequent events, which we defined to be events that provide additional evidence of the conditions that existed before the financial year end. We also say that these are events that require adjustments to the financial statements. We also mentioned that these are events that affect the financial statements, and that's why adjustments are necessary. We've gone ahead to give examples of recognized subsequent events. Number one is settlement of litigation. Number two, purchase or sale of assets. Number three, bankruptcy. Number four, changes in accounting estimates. 1, 2, 3, 4, given 4 examples. Then we defined non-recognized subsequent events. Non-recognized subsequent events. We say that these are events that provide information about conditions that arose after the financial year end, and such events do not require adjustments to the financial statements. And we've gone ahead to give examples. 1, issuance of debt or equity securities. Number 2, natural disasters. Number 3, significant business acquisitions. Number 4, changes in regulations and laws. That we did in our today's lesson. Then we finally discussed in this lesson audit work done between the financial year end and when the financial statements are issued or authorized. We've outlined 8 audit procedures. Number 1 is inquiry and analytical procedures. These are 2 in 1. Inquiries: making inquiry of management, making inquiry of the key personnel of any events that may have occurred during that period. The second procedure, audit procedure, is review of subsequent events, documentation. Review of subsequent events, documentation. If there are any events that occurred between the financial year end and the date of signing the financial statements, documents such as the minutes of board meetings or documents about management discussions, the auditor should review such documentation so that he can establish if there are any significant subsequent events that require disclosure or that may cause the financial statements to be adjusted. Cut-off procedures. Number 3, evaluation of recognized subsequent events. Number 4. Number 5, disclosure of non-recognized subsequent events. That is another procedure that has to be carried out by the auditor. Number 6, updating risk assessment. Number 7, management representations. The auditor must get representations from management. Okay, obtain written representations from management regarding subsequent events, and these representations confirm that management has disclosed all known subsequent events that are relevant to the financial statements and that appropriate adjustments and disclosures have been made in the financial statements. Then lastly, review of events occurring after the date of the auditor's report. The auditor also has an obligation to review the events occurring after the date of the auditor's report. And in closing, candidates, the work done between the financial year end and the date of signing the financial statement is crucial in ensuring that the financial statements are accurate, complete, and that they reflect the most up-to-date information available. This work also helps auditors identify subsequent events that may require adjustments or disclosures, at the same time maintaining the reliability and the relevance of financial reporting. And on that note, we bring the lesson to a close. subsequent events, and audit work done between the financial year end and the date of signing the financial statements. Thank you. God bless you.
Hi candidates, welcome to another session of Manifested Online Classes. So we are still soldiering on with our syllabus coverage, and we are still in topic number 4, and I want us to look on the subtopic number 3, and the topic is IFRS 8 operating segment. So in this particular topic here, we're going to look on what is an operating segment, the information to be provided to the shareholders, or basically to the users of the financial statement as far as the operating segment are concerned, and also we look on the preparation on how a segment report is actually prepared. So first of all, when we talk about a segment basically refers to a component of an entity, or basically a geographical area in which a company operates in. So mean that we have a number of, or basically most of the companies actually, or most of the businesses operate in a number of geographical areas. For example, a company may be having a number of branches, or a company may be providing various products or various services. Now, such a company is required by this particular standard here, that is IFRS 8, to be able to prepare something called a segment report. And that segment report is intended to provide more information to the shareholders, more information to the other users of the financial statement as far as each component of the business is concerned, or as far as each unit of the business is concerned. And therefore, basically here we're going to look on how do we prepare that particular segment report, which information need to be included in that segment report, and which segment should be reported on. But before we do that, we can say here that many companies, or we can just say many businesses, all companies operate in different geographical area, and also provide various products, or services, to their customers. So here we are saying most of the companies operate in a number of geographical areas. So by saying companies operate in different geographical areas, this means that a company here can be operating in a number of geographical areas. Or in other terms, a company may be having a number of branches. For example, a company may be having a branch in Kenya, a branch in Uganda, and also a branch in in Tanzania. So this particular company here, other than preparing, for example, the income statement for the whole company, whereby the company will be showing the revenue by the entire company from the 3 branches, the expenses of that company, which is incurred now by the 3 branches, and also the profit of the whole company. This company is expected to prepare a segment report which will be giving information about each of these branch. For example, the revenue from each of the branch, the cost which is incurred by each of the branch, and how much profit was reported by each of the branch. Equally, if a company provide a number of, or basically deal with a number of products, or a company provide a number of services, maybe a good example we can take, an example of a company like Safaricom. This company, we know it deal with a number of products. So one of the product of Safaricom is M-Pesa. We also have data. We also have airtime, and so on. So these are some of the product of Safaricom. So Safaricom at the end of the year, other than preparing the income statement for the whole company, whereby it will be showing the revenue for the whole company, the profit for the whole company, Safaricom should also go ahead, in accordance with this particular standard here, IFRS 8, prepare a segment report. That segment report will be showing, for example, the revenue, generated from each of the product here, how much profit was reported by each of what of the product there, and actually how much cost was incurred by Safaricom in terms of providing each of these particular what a service. So therefore IFRS 8 basically provides some principles regarding what if as the segmental reporting, or basically provide the principles regarding how a segment report should be prepared, which information is to be included in such a segment report, and so on. So therefore, we can proceed and we say that such companies, basically the companies operating different geographical areas, providing various services or product, we can say such companies are required by IFRS 8, International Financial Reporting Standard number 8, to prepare a segment report, And this particular segment report here will basically be provided for each product, for each service, or basically for each geographical area in which now the company is operating in. So we can further proceed and we say that a segment report, this one provide information about this particular segment of the company, or this business unit of the company, like product, like maybe the services, of which that particular information, number one, it helps now the users of the financial statement to be able to make a more informed decision, and so on. So therefore, you can say segment report provide information about performance. Provide information about performance of different business units. So in this case, when we talk about the unit of the business, we are talking of products. We are talking of a product. We are talking of what? The services, etc. So segment report provide information about performance of different business unit to enable the users of financial statements to have a wider perspective, of the business, and make more informed decision, about maybe such a company, or basically such a business. So therefore, the main objective of this particular segment report, which will be prepared by companies in accordance with IFRS 8, is basically to provide information about the performance of different business units, which you are saying these include product, these include services, these include branches of the company. And this particular information contained in the segment report, we are saying it enable the users of the financial statement to have a wider perspective, a good understanding of the business of the company, and that help now those particular users in terms of making a more informed decision. From there, I think we can proceed and we define what is an operating segment here. So let's look on the definition of an operating segment. Definition of an operating segment. So an operating segment, generally, we have said this is a component of an entity. A component of an entity, we are talking of maybe a product, which a company produce and sell. A component can be a service provided by what? By a company, or can even be a branch. If a company has a number of branches, those particular branches can be regarded to be what? Operating segment. So how do we define an operating segment? So an operating segment is defined to be a component. We say this is a component, of an entity, a component of an entity, number one, which engage in business activities, from which it earn revenue and incur costs. It is that particular component of an entity which you are saying engage in business activities from which it earn revenue and also do what? Incur cost. If you take a good example of a product of a company, you'll be able to see a product will fit that particular definition, because a product, we say, is a component of an entity that engage in business activities from which it earn revenue and also incur what? Cost. Number two, we say an operating segment is a component of an entity whose discrete in this case, we are talking of a separate financial information is available. Discrete or separate financial information is available. And number three is a component of an entity whose operating results are regularly reviewed by the entity's chief operating decision maker, entity's chief operating decision maker, to assess its performance, and know the resources to be allocated. So that is the definition of an operating segment. A component of an entity which is engaging in business activities and it is earning revenue and also incurring cost. And then you're saying, number two, you're saying whose discrete or separate financial information is available. And finally, whose operating results will be regularly reviewed by the person in charge of making decision in a company for him to be able to assess its performance, and two, to be able to know the resources to be allocated to such what? a component. So that is a definition of an operating segment. Next, let's look on something called a reportable segment. Reportable segment. So in this case, when we talk about a reportable segment, basically this is a component of an entity which must be reported on, meaning that when the company is preparing a segment report, then separate information about such a segment has to be provided separately or has to be provided separately in the segment what? In the segment report. So in this case, we can say a reportable segment, and this is a segment to be reported on, i.e. it financial information must be reported separately in a segment report. In a segment report. Yes, so now for a segment to be said to be reportable in accordance with IFRS 8, such a segment should meet various criteria. Such a segment must meet various criteria. We can say for a segment to be reportable, it must meet the following criteria. Which is that particular criteria? Number one is that such a segment must meet something called quantitative criteria, not quantitative, rather qualitative. Qualitative criteria. So in this case, when we talk about the qualitative criteria, we say it must meet the definition of an operating segment. It must meet the definition of an operating segment. Remember, in our case here, we have defined what is an operating segment. We have said is a component engaging in business activity. It is earning revenue, incurring cost. Its separate financial information is available, and also its operating results are regularly reviewed by the person in charge of making what decision. So if a segment meets that particular definition, then we say it has met now the qualitative criteria. It is a reportable segment. When the company is preparing a segment report, separate information about such a segment has to be provided in a segment report. So number two, we say that it must meet at least one of the following quantitative criteria. One of the following, at least one of the following quantitative criteria. So which are those quantitative criteria? Number one, we say its revenue, which is both now external and intersegment. Intersegment revenue. Intersegment revenue, in other terms, is the internal revenue. The revenue between segment. For example, a company having a number of branches, one branch can make the sales to the other. That is an intersegment or internal revenue. So its revenue, which is both internal and external, must be 10% or more. 10% or more of combined revenue, combined revenue, and that is now the total revenue for all segments, So therefore, if the revenue of a segment, both internal and external, is 10% or more of the total revenue of all segment, then such a segment has to be reported on, or is a reportable segment. Number two, we say its assets are 10% or more, 10% or more of total assets. Equally, if the assets of a segment are 10% or more of the total asset for all segment, such a segment is a reportable segment. And number three, we say it's a profit or loss. It's profit or loss in absolute terms. In absolute terms is 10% or more. 10% or more of total profit or loss. So mean that for segment to be reportable, then you are saying its profit has to be 10% or more of the total profit for all segment making what? A profit. Or its loss has to be 10% or more of the total loss. So basically what that means here, let's assume that a company is having like 4 products, product A, B, C, and D, and we are given some information here. We are told the first 3 products here maybe reported a profit of 10 million, 5 million, and maybe something like what? Like 5 million, which is a profit. But the last product here reported a loss of 10 million. That is a loss. So in using this particular criteria here, we are saying, first of all, consider those particular segments which are making profit only. Don't take into account the segment making the loss. Get the total profit here, which will be 20 million. And then you express this as a percentage of the total profit. So 10M all over 20 million times 100. And that will be 50%. So, and then you do the same here, 5 million all over 20 times 100 times 100. So this will give us 25 what? Percent. So mean that the profit for these 3 segments, you can see, is more than 10% of the total profit for the 3 segment making what? The profit. But now for this particular segment which is making the loss, you need to consider its loss on its own, or basically get the total loss. The total loss will be 10 million, and we are saying take that particular loss in absolute term. You ignore it is a negative. Ignore that negative. So, and basically here you take the loss for that segment, divide that with the total loss. We only have one segment making a loss. So once you express that as a percentage, that will give you 100%. So therefore, using this particular criteria, we can say all the segment are what? Are reportable. All the segment are what? Are reportable. So therefore, this is how a company is able to identify which segment is reportable and which is not. So therefore, we are saying for a segment now to be reportable, number one, it has to meet the first criteria, the qualitative criteria. It must meet the definition of an operating segment. And then number 2, we are saying it has to meet at least one of the following. At least one of those particular what? At least one of those particular 3 quantitative what? Criteria. So then from there we can proceed and look on something else as far as the segment is concerned. I want us to look on the disclosure requirements. Disclosure requirements. Yes, disclosure requirements. So in this case, when we talk about the disclosure requirements, we are talking of the information to be disclosed as far as each reportable segment is concerned in accordance with IFRS 8. So which information need to be provided to the shareholders and other users of financial statement as far as each segment or as far as each reportable segment is concerned. So the first information is information about the segment revenue, both external and internal, So the other information to be provided for each segment is information about the segment assets, number 3, and basically in this case we can talk of mostly PPE, property, plant and equipment. So we also have information about the segment what? The segment liabilities. We also have information about the segment profit or loss. This information also need to be disclosed. The other information the company need to disclose as far as each segment is concerned is information about the depreciation the depreciation and amortization of each of the segment. The other information which also need to be disclosed is the criteria used by the company, to identify reportable segment, segment. Also, the company need to disclose information about certain items of incomes and expenses of each segment. So these items of incomes and expenses to be disclosed include information about interest income or the finance income, and the interest expenses. So this is basically the information which the company is expected to disclose as far as its reportable segment is as far as its reportable segment is concerned. So I think for the time being, we can stop at that point. I want us, once we come back, we look on an illustration question which was tested in one of the past papers. So here is today's assignment. Question 1. In context of IFRS 8, define an operating segment. Question 2. Outline the disclosure requirement for a reportable segment under IFRS 8. Question 3. Explain what is a reportable segment and the criteria to be met by such a segment. In our next session, we are going to look on how to prepare a segment report, how we prepare a segment report, and equally we look on an illustration regarding the presentation of a segment report. So see you in the next session.
Hello and welcome to the lesson. The subject is Advanced Auditing and Assurance. In our today's session, we will be looking at other special audit assignments. Having done around 6 or 5 subtopics, the chapter is Audit, Evaluation and Reviews. In our previous sessions, under the audit of companies, we studied audit of consolidated financial statements. We looked at the audit of banks and non-banking financial institutions. We studied the audit of general insurance companies. We went ahead to study the important points to take into consideration when auditing cooperative societies. In our session, we covered the audit under taxation laws. In our today's lesson, we're going to look at the factors to consider or matters to pay attention to when auditing other special audit assignments, when carrying out other audit assignments. And candidates, other special audit assignments refers to specific engagements that are outside the scope of regular financial statements audits. We know that the auditor is required to carry out audit on financial statements, but there could be other special audit assignments which you are referring to other special audit assignments. And these assignments are typically tailored to meet the specific needs and the objectives of the audit or a client, and may involve various areas of examination and reporting. In our today's lesson, we are going to look at a few examples of other special audit assignments. And the first one being the forensic audit. Forensic audit. Number 1, forensic audits. This is one special audit assignment, forensic audit. Now, these audits, forensic audits, focus on investigating and uncovering potential fraud, misconduct, or irregularities within an organization. And forensic auditors use specialized techniques to collect and analyze evidence, interview relevant parties, and provide expert opinions in legal proceedings if necessary. That's forensic audits. Then there is number 2, compliance audits. This is another example of a special audit assignment. The auditor may carry out compliance audit. And compliance audits assess an organization's adherence to specific laws, regulations, and industry standards. And these audits ensure that the organization is complying with relevant requirements and may cover areas such as environmental regulations, areas like data protection, financial regulations, and occupational health and safety standards. The third special audit assignment is the internal control audit. Internal control audit. Now, internal control audits evaluate the effectiveness of an organization's internal control systems in managing risks and safeguarding assets. And these audits assess the design, the implementation, and the operation of internal controls to provide assurance that financial reporting, operational efficiency, and compliance objectives are met. That's the objective of internal control audits. Then number 4, we have what we call information technology audits, IT audits. IT audits. IT audits focus on evaluating an organization's information technology systems, processes, and controls. These audits, the IT audits, assess the security, the integrity, and availability of data, as well as the effectiveness of IT governance and risk management. And it's important to note that IT audits may also examine areas such as system development, areas such as network infrastructure, and data privacy and protection. So an auditor may be asked to carry out special audit on information technology. 5, performance audits. Performance audits. What are performance audits? Now, performance audits assess the efficiency, assess the effectiveness, and also the economy of an organization's operations or specific programs. These audits evaluate whether resources are being used optimally, whether objectives are being achieved, and whether there is compliance with relevant policies and regulations. Performance audit is another example of a special audit that may be carried out by an auditor. Due diligence audit, number 6. Due diligence audits. Due diligence audits are conducted as part of a business acquisitions or mergers. These are audits that provide an independent assessment of a target company's financial statements, operations, and also risks to help the acquiring party make informed decisions and evaluate the financial viability of the transaction. So if company A would want to acquire company B, then company A may engage an auditor to carry out a special audit known as due diligence audit, such that after which the company will be unable to have information as to whether to acquire company B or not. It is an independent assessment of the target company's financial statements, operations, so that the target, the acquiring company can get more insights and make informed decisions about the viability of acquiring the target. Due diligence audit. Grant audits, number 7, is another example. Grant audits. Grant audits are performed on an organization that receive funding or grants from the government agencies or from foundations or any other sources. And such audits verify that the funds are used in accordance with the terms and conditions of the grant, and that the organization has complied with reporting requirements, and the organization, we can also say, has achieved the intended outcomes. So candidates, these are examples of special audit assignments. All right? They are just a few of many other special audit assignments. And candidates, the specific nature and scope of these assignments will vary based on the client's needs and the objectives of the engagement. And auditors who perform or conduct these special assignments may require additional expertise, may require specialized methodologies and knowledge of specific regulations or industry practices. If an auditor is to carry out an audit in information technology, then the auditor needs to have expert knowledge in IT. The same as forensic audit. Specialized knowledge is required to carry out compliance audit. Specialized knowledge is required to carry out internal control audits. Specialized knowledge is required to carry out due diligence audits, grant audits, and so on. So these are just examples of other special audits that may be undertaken by an auditor over and above the regular audit of financial statements of institutions. These just examples. In our today's lesson, we gave out examples. We'll be looking at specific ways in which these special audit assignments can be carried out. We'll be discussing in detail, particularly in our block revision videos. We'll be looking at comprehensive questions that will help us understand how to carry out audit procedures in so far as special audit assignments are concerned. Thank you for your time. God bless you. Bye-bye.
Greetings to you all and welcome to our today's lesson. My name is Nicholas Sikali. Our today's lesson will focus on pivot tables in Excel. Pivot tables are a powerful tool that is used for data analysis in Excel, and it enables you to interact with huge sets of data in a way that you want. So for pivot table, you can be able to summarize huge data set, and come up with some more tables that will be able to make you understand the data that you have better. So in pivot table, you will analyze data interactively, come up with other tables and be able to make more viable interpretations and decisions from the new tables that will be created from one table, of course, which we'll be having at the initial point. So welcome, and I believe you will enjoy this session. So with me here, I have a huge data set which we'll be using to be able to explore our data table techniques, or our pivot table techniques. You can see with me here we have the order ID in column A. Order ID in column A, it moves up to all the way to 213. We have the second bit. We have the second bit here, which is product. Different products like carrots, broccoli, banana, orange, all the way. There is category. Of course, they are categorized either into vegetables or fruits. We have amounts that were sold. We have the dates that each one of them was sold. And we have the specific countries that relate to that. So we want to make interpretation from this particular table, you can see. And within a short period of time, if you are to be asked, which country do you think made the most sales? Of course, which country? Is it the United States that made the most sales? Is it Germany? Is it Canada? Is it France? Which country made the most sales? It's very difficult for you to be able to tell that. You can be asked, which product between carrots, broccoli, banana, beans, apple, and all these products here, which one was sold most? And again, you can see it's very, very difficult for you to come up with that particular decision. Which category between vegetables and fruit had the highest amounts of revenues or sales? Again, it becomes very difficult because the data is too huge. Remember, it's ranging from 1 all the way to 213. So it's huge. You can't really tell how much was from apple, how much was from banana, from beans, from orange, from carrots. It's very difficult, and you really, or you can spend the entire day analyzing this data and finding out which product had the highest, which category had the highest, which country had the highest. So it becomes very hectic and very difficult. But with the help of pivot table, you can be able to come up with sub-tables from the main table, from which reading of data becomes very easily. You can come up with the reports at any time, at any point, using the shortest time possible. You can do it in a matter of seconds and come up with a list of products, or a list of countries, or a list of categories that had the highest amount of revenue. So welcome, and I believe this session will provide you with an opportunity to be able to interact with this huge data set and break it down into sub-reports that can be able to help you to make decisions using the shortest time possible. So pivot tables, and for you to be able to access pivot tables, they are inside the insert menu, and you can be able to see pivot table here. So insert menu, and you can be able to see pivot table here, and when you click on it, of course, you can see that you have an opportunity to be able to do it from a table, and you can also be able to do it from an external data source. So it can either be from a table or a range. When you click on from a table or a range, it means you have to select all this. To make your work easier, instead of, again, this is a range now, selecting the range, to make your work easier, you prefer, or personally I prefer, making pivot table from a table and not from a range. From a table and not from a range. That is what I personally prefer. But you can also be able to make it from a range, as we are going to see. Now first, I want us to format our data in form of a table. We want to format this data in form of a table so that it's arranged in form of a table. Of course, we have advantages of formatting data in form of a table. That is, in case you add a new data like 214, the table will automatically be adjusted. So that is very important. So let us format our data in form of a table. That is, you click inside anywhere in your data. Just click inside anywhere here in your data. You click inside anywhere, not outside, but anywhere, just anywhere inside your data. Then go to the home menu. Under the styles group, you can see the styles group here. There are three things: conditional formatting, format as a table, and cell styles. I want us to use format as a table. So our data now will be formatted as a table. You click on the arrow, you pick any style. You can go for any style here. I will go for a style which has some blue, and let me pick that. Now our data, you can see the range has been picked to the end. Nothing has been left out, all the way to 213, all the way to column F. So all the way to F214. F214 has been picked. Click on OK, and now our data has been formatted in form of a table. Now this is a table now, and you can see it even has the filters. You can be able to filter things out and do that. Now that is formatting data as a table. The importance of formatting data as a table is that if you are adding, let's say 214, and you have some orange, you can see that the data gets updated automatically. If you go to 215 here, the table gets updated. It keeps increasing to include 214, 215. The range keeps increasing automatically. So that is the beauty of formatting your data as a table. We will use 213 as we had there before. Remember, you can change the styles if you want by just clicking anywhere inside. Then you can change to any other style. If you prefer any other style here, you can still be able to change your data into variety of styles that are provided in Excel. Once you've done your first step of formatting your data as a table, which is not mandatory, by the way, it's not mandatory that when doing pivot tables you format your data as a table, though it's highly recommended. The second step is that now you go to insert and pivot table. Insert, then pivot table. So I'll click on pivot table, then we will click on from table stroke range, there. Then you can see we picked table 1, so no need of selecting anything. Table 1, and that is the table or range. Already it's table 1. Choose where you want the pivot table to be placed. Where do you want it to be placed? Is it new worksheet, existing worksheet, or where? We want it to go to a new worksheet. Then you just click on OK, and you will have that. So what we have here is sheet 1. Remember this pivot table here, the data that we had initially, but a new worksheet has been added here known as sheet 1. So we are on sheet 1. So we have pivot table, which we have here, then we have sheet 1. So I'm going to start with certain things that you see here. This is where our report will be placed. Our pivot table report will be placed here. But we have pivot table fields on this particular side. You can see choose fields to add it to the report, and no need for using that. There is also these particular fields here. You can see order ID, which was the first one here. You can see the order ID. We move back to category. There was category there. There is amount, there is date, there is country, and so many things. You can be able to go to more tables if you want. Now there is dragging the fields above between the areas below. There is filter, there is column, there is row, and there is values. You can see how that looks like. Now we want to, assuming that you want your category or your product is to be dropped on columns. Look at what happens. If you want your product to be dropped in columns, that is what happens. Let us untick. I want to drop products in rows. And this will come here that way. So products in rows. You can see products in rows, and our report is building up. Then I want to see these products. What are the values attached to them? So amount into values. If you take amounts to columns, that is what happens, but I don't want my work to look like that. So amount to values, and that is what you will see there. I want to remove the other one and take amount to values, and you come up with that. So this becomes very easy, and actually within seconds you can be able to see that that Apple had an amount of let me input column so that we can clearly see that way. So Apple sold 191, 257. Banana, you can see, sold 340, 295, 557, 281, 142, in that order. With a very short period of time, you can be able to tell and retrieve such a small report from what you have there. You can do a lot. Assuming that you want country, you can even drop country to columns if that is what you want. If it looks so bad, you can just drop this to rows. That is how it will look like. Now look at that report, it has changed. If you take country to rows, this is what you see. And it gives you apple in specific countries, banana in specific countries, beans in specific countries. So if you want to undo country, of course you just remove the country and you remain with that. So I just removed the country from the other side. What if you want the country to be in values? That is what will look like. Apple count of countries, and you can be able to see that. So I will remove country and remain with this small report there. Category, if you want to bring in category and take it to either columns, you can see the category. I'll undo. You can take category to products and you can see what happens. And category inside products. So I'll undo category and remain with this small report. I'll save that report. Of course, I'll close this and now save this report to analysis of products. This is products and amount. Product and amount. So that is a report showing you the product and amount there. I can give this a color. Product and amount. This one I can also give it a color red on the other side. So we have, of course, let me move this before product and amount. No, not creating copy, so that it's the first one. So we have pivot table followed by product and amount and all that. Now from this huge data set, which will take a day for you to analyze the products and the amount of sales that they made, we've used a very short period of time to get product and amount here. So let us do another one. Again, pivot table, insert pivot table, then here, then same range, then okay. We want to do another one. What if it is category? So you take category and put it inside rows like that. Which category led? So category against amount or against values. You can see categories against values. And you can see vegetable and also the other one. I will include the zeros and the commas. The category that led was fruits, which was at 693,069. Vegetables followed at 336,665. So I will rename to category and amount. So that is category and amount. Then I will give it a color from which we can move it to end. So we are moving it to end. Then okay, so now it is at the end. You can see category and amount. Again, from this data set we want to do another pivot table, which is a bit more complicated, including so many things. So pivot table, then okay, and here we want to start with the ID. The IDs will be under filters, or maybe no. I want to start with category under rows, not necessarily category but products. Let products be under rows, then category also that way. No, let me start again. So I'll start with category under rows, then products also under rows. So you can see category, then products also under rows. Then we have the country, which we can put under columns, country under columns. Then the amount can also be seen under values. Now look at that. A very another dynamic of how a pivot table can look like. Like fruits, total of 91 to, that is 91, 9, 12, and what? Let me put the 0 so that it can clearly be seen. In the home menu, you put the commas and you reduce the zeros. Fruit in Australia amounted to 91, in Canada amounted to 82, in France amounted to this. Apple, again, the same breakdown of things in every other thing. So these are more complicated kind of reports that you can be able to make from that huge data set, where we had product, category, amount, and country. So this one can also be able to be saved here, and this will be, it has a, I can give it a name, analysis 1, analysis 1, maybe analysis 1 there. Then I can move it to end. Let us move it to end. So move or copy, move to end, then OK. Then tab color, that way, in tab color, one that is more, yeah, that is fine. So this analysis 1, where you can be able to see categories like fruits and the countries, different products, countries and the total, category of vegetable and different countries, beans, of course, under vegetable we have this, and also with various items there. Now we have analysis 1, we have category and amount, we have product and amount, then we have our main data that is from the pivot table which we have here. The last one that I want us to try is that this can also be even more complicated, and one can come up with something that it's even hard to read. Like we have that, then we have it goes to columns, you can see there. Then we have countries, which also goes here. That one looks bad, so country, I'll take it to rows. Look at that. Then amount, I'll take it to values. So this is what we have now. A very other complicated, though it's understandable, like fruits, vegetable, and grand total on the other side. You can select and give it some, select home, then the zeros after the commas here, we reduce the zeros to what we have there. Now look at the first one, fruits. There is apple and vegetable, of course, from different countries and all that. Now this is another set of pivot table which we can call analysis 2. So this one can be analysis 2, like that. Then move this to end, move this to end, and of course it's at the end there. Can give it a color, and this can be that one of a color. Now look at that. We started with the data from which making a decision was very difficult. Somebody would ask you a simple question and one cannot even tell, like, which category between fruits and vegetable had the highest. You will take so much time, but with pivot table you can quickly get here. Now which product had the highest? With pivot table you can be able to see that it is our bananas that took the highest. You can see category and amount, this analysis 1, this analysis 2, and so many things. One can do a lot. For instance, you can create another pivot table and say okay, and just do these things randomly. Like you want this to come here, you want this to come here, and no, I'll do away with that. You want this to come here, you want the countries to come under category, you also want the countries to go under columns, and that one looks bad. You want the amount to come here. This is another set of pivot table that you can come up with. So this one can be given analysis 3. So you can do a lot of analysis from your pivot tables, comma, then we will reduce that to that point. So this will be analysis 3 of pivot table. Again, this can be interpreted. We have fruits and other fruits. You can see countries, and this one is giving you different items, vegetables, and also different items here. So this will be analysis 3 after changing the color. We'll give it analysis 3. Analysis 3 in that order, and clearly it's now taking shape. We'll move this to end, so move or copy so that it's taken to the end, and okay, this can always be closed and we remain with our data here. Now we have the first one, which was pivot table, our data which we formatted as a table using this option. We did a simple one here, that is product and amount. There is category and amount. There is analysis 1, this analysis 2, and this analysis 3 of doing this pivot table. And remember, pivot tables usually go as well alongside the pivot charts, which is also done the same way. So up to that point, I believe that you should be in a position to do pivot tables. The file that we used will be shared below the video description so that you can be able to do your practice. You can be able to do practice on your own and come up with various summaries from a huge data set. That means you work with your data interactively and come up with so many other reports from the main table, which can be used for various decision making ideas or analysis of data to come up with different views. Bye for now, and see you again.
Hi candidates, welcome to another session of manifested online classes. So we are still continuing with the topic of public sector accounting, and in this particular session, I want us to look on IPSAS 26, which deals with the impairment of cash generating asset. Now, the first important point for you to note here is that IPSAS 26 is drawn primarily, or is written primarily from IS 36. So meaning that in terms of how we determine the impairment loss under the two standards, IS 36, International Accounting Standard number 36, and IPSAS 21, IPSAS 26, the same approach is used. And if you can be able to recall what we said under IS 36, or in the topic of determining the impairment loss under IS 36, we said impairment loss of those particular assets which are owned by the private owned entities or the profit oriented entities is equal to the carrying amount minus the recoverable amount. The recoverable amount we were determining that as the higher of two values, the net traceable value or the fair value less cost to sell, and the value in use. And the value in use we were determining that as the present value of the estimated what? Cash flow. So that is the same approach which is used under this particular standard what here. But maybe first of all we can say that IPSAS 26 is drawn primarily from IS 36. IS 36. So basically this means that the two standards are the same. Are the same. It's drawn primarily from IS 36, and therefore impairment loss under the two standards, the two standards we are talking of IS 36 and IPSAS 26 is the same. Impairment loss under the two standards is determined in the same way. Determined in the same way. Let's look on how we determine this particular impairment loss under the two standards. So the impairment loss in this case is always equal to the carrying amount of an asset, or basically the cash generating assets. And then to this we layer something called the recoverable amount. So we don't use the word recoverable service amount as we were using under IPSAS 21, but here we talk of recoverable amount. So the carrying amount or the net book value, this is determined in the same way. We take the cost minus what? The accumulated depreciation. But what about the recoverable amount? The recoverable amount. So the recoverable amount, this is defined as the higher of two values. So basically we can say that this is the higher of cash generating assets. Number one, net realizable value, or the fair value less cost to sell. So basically this is the amount the entity will get after selling the asset currently minus the cost which will be incurred in selling that particular asset. We take the higher of that, all over 2, something we refer to as the value in use. The value in what? In use. The value in use. So and basically in this case, when we talk about the value in use of cash generating assets, value in use of cash generating asset, this is equal to the present value of the expected cash flows, expected to be generated from continued use of the asset, continued use of assets, use of assets, and from its disposal, So that is how we define the value in use of a cash generating what? Unit. Recall what we said in our previous session. To determine the value, or basically the value in use of a non-cash generating asset, we define that as the present value of the remaining service potentials of a non-cash generating asset. So therefore, you can see the definition of this particular term here. The value in use under IPSAS 21, IPSAS 26 is different. That is something which is important for you to be able to do what? To note. You may come across a question whereby the examiner is requiring you to define the value in use under IPSAS 21 or under IPSAS 26. You can see the definition is what? Is the same. So I think we can look on additional definitions here, which equally you may be required to define in an exam. Additional definitions. The first term maybe we can start by defining here is a cash generating unit, abbreviated as CGU. So when talk about the cash generating unit, basically we say this is a group of, or actually the smallest group of identifiable assets which are owned by an entity, or which are held by an entity with an objective, with a primary objective of generating some cash flows, which are largely independent from cash flows generated by other assets. So therefore, you can say that this is the smallest identifiable group of assets held by an entity with a primary objective of generating commercial returns, or basically cash flows that are largely independent largely independent from cash flows, or basically from other or from commercial returns, cash flows or commercial returns generated by other assets, or group of assets, or group of what? Of assets, or group of assets. So that is how we define a cash generating unit. A group of what? Asset, which are held with a primary objective of generating cash flows, which are independent from cash flows, which will be generated by other what? Assets. So the other term we also need to define here is maybe we can define the value in use, although I think we have briefly mentioned that here. So we define the value in use of a cash generating asset. And we have said that this value in use of a cash generating unit is quite different from the value in use of a non-cash generating unit, because we have said that this is basically equal to the present value of the expected cash flows. The expected what? Cash flows, which will be generated from the continued use of the asset and also from its disposal. Disposal. So these are basically some of the terms which the examiner, or which you may be required to define in an exam. One of it is the recoverable amount, and in this case we are talking of the recoverable amount of cash generating assets. Cash generating what? Assets. You may also be required to define this other term here, which is a cash generating unit, and also what you refer as the value in what? In use. But basically what you have said is that IPSAS 26 and also IS 36 basically are the same, meaning that how we determine the impairment loss at the two standards is actually the same. And actually we don't have any question which has been tested from this particular standard here, whereby the examiner was requiring a candidate or candidates to compute now the impairment loss under IPSAS what? 26. So the questions which are usually tested are questions under IAS what? 36. So most of the questions which come from this particular standard here, they require you to define a number of what? Of terms. Like you can be required to define the cash generating unit, the what you refer as the value in use of cash generating asset, or maybe the recoverable service what? Amount. So that basically is the end of that particular small subtopic regarding determination of impairment loss of the cash generating assets in accordance with IPSAS 26. So for now, here is today's assignment with reference to IPSAS 26, impairment of cash generating asset. Explain the following terms. Number 1, value in use. Number 2, recoverable amount. And number 3, a cash generating unit. So that is today's assignment. See you in the next session.
Hello learner, welcome to Manifested e-learning forum. My name is Emlyn Gwiri. I'll be taking you through equity investment analysis, and today we are going to be looking at a new topic. The topic is called equity market equilibrium. Equity market equilibrium. Yeah. Specifically, what we'll be looking at, we'll be looking at the following. Number 1, we'll look at the justification, just a brief explanation about the justification for the short term and long term equilibrium. Yeah, just a brief description about that. Of course, this concept has already been covered under economics. I believe once you've reached this level, you must have done economics at some level. Then we will move on and look at the Greenwald-Kroner model. Greenwald-Kroner model. There. This model is useful in trying to estimate the required return within the market, and what we will be able to look at, we will be looking at the formula of how to compute the Greenwald, the required return under the Greenwald-Kroner model. We will be able to specifically look at the inputs there. Then once we look at the Greenwald-Kroner model, we will be able to move on and look at the Cobb-Douglas. Cobb-Douglas we're saying economic function, economic function there. Then we will move ahead and look at the macroeconomic forecasts, macroeconomic forecasts, and we will specifically look at the H model. We will be able to build on the H model. We had looked at it under the dividend discount model, H model there. Then we move on, building on the topic, we will be able to now look at something as the relative equity market or relative measures of the equity market equilibrium. So we say relative equity market valuation, equity market valuation there. Then we will now specifically look at the following. We will first of all look at the Fed model there. Then we move ahead and look at the Yardney model. I'm trying to look at the equity market valuation. Then we move ahead and look at the 10-year moving price, 10-year moving average price there. Now, once we look at these three relative equity market valuation approaches, we will be able to move ahead and look at now asset-based approaches to equity market valuation, equity market valuation there. And specifically, we will be looking at the Tobin's Q. We will be looking at the Tobin's Q. Tobin's Q there. Now, this is what we expected to cover so that we can be able to go and understand the equity market equilibrium under equity markets or equity investment analysis. So we start off by looking at the justification for the short term and long term equilibrium. So what we expected to understand over here, we expected just to understand the traditional curve over here where you have the price of a commodity. In this case, you're looking at the price of the market here and the quantity produced there. And we are saying we will be able to have an equilibrium price right at this part over here like that, and that is what we're saying based on these curves over here. Sorry, we're saying this is the demand curve there, and this is the supply curve there. So it is expected that this is the equilibrium price that will be accepted by both producers or producers and consumers, at which they can be able to buy the product or they can be able to supply into the market. So we are saying the justification in the short run is that an increase or a decrease in the demand will cause some kind of effect that is going to be significant to try and change the equity market equilibrium, say for example to the new equilibrium value over there like that. So we can put it in writing and say something that In the short run, an increase, decrease in demand for assets, securities in the market will cause prices and output to increase, into brackets, decrease, like that. That is in the short run. As well, we can say in the short run, in the long run, apologies, long run, an increase, brackets, decrease in demand for assets, to brackets, securities, will have the same effect in the market like that, will cause prices to increase, decrease, but after some time to be influenced by macroeconomic factors. So such as, I can be able to put it such as the GDP, inflation, interest rates, amongst others. I can put ETC there, pardon me, ETC, and prices will tend to stabilize in the long run. Stabilize in the long run, stabilize to the long run average prices, in to stabilize to the long run average prices. There. That is what we just need to understand under the justification for the short term and long-term equity market equilibrium or equilibrium prices. We know very well that the fundamental analysis in terms of looking at the DDM, discounted dividend model, the free cash flow valuation, we also mentioned about residual income, and finally market based valuation, price and enterprise value multiples, all represent fundamental analysis. It's there. So market based valuation there, and this has a tendency, or these decisions based that have been arrived at under the DDM, the free cash flow, residual income, and market based valuation, will be able to be guided, or will be able to guide an analyst when they're looking at the long run. We are saying under technical analysis, this is an analysis that technicians use to try and make some inferences when buying securities in the short run there. So this is using the graphs, charts, and also market indicators, as well as mathematical indicators to try and predict market movements in the short run there. So it is an important concept that we need to understand, that in the short run, the increase and decreases in demand for assets in the market will cause prices and output to also decrease. As well, for the long run, we'll have a mirror effect as over here, but it will tend to stabilize to the long run average prices there. Remember one thing, marginal revenue should be equals to marginal cost. So that important concept would mean that if the cost of offering securities in the market should be able to be at least as much as, rather, the revenue that is to be earned in the securities market should be almost as equal, or should be able to compensate for the cost of entering the market at any given point in time. So that concept is very important in economics as well as in equity investment analysis. Now, having looked at the justification for the short-term and long-run equilibrium right over here, now we move on and look at the Greenwald-Kroner model that is used to estimate the required return within the market there. So the Greenwald-Kroner model, we say it is a model that is used in the securities market, the securities market. You can see the securities market. To compute the required return, forecasted return, which is what you're saying is the forecasted return there. The formula is simple. We have R is given as D over P, which we're saying that is the dividend yield, D over P plus inflation. Then we add the growth, long-term growth rate component there, which will be given in the question there. And then we minus the supply, the S, or change in supply of the asset, change in supply. Then we add the component of the change in price to earnings ratio there, where R is required return there. D over P we're saying is the dividend yield there. I is the inflation component, or changes in the purchasing power of goods and services, inflation. Then G is the growth rate, long-term growth rate. Like that. Once we have the growth rate there, we also have changes in supply of the asset. Change in S is change in supply of the asset, or security in this case, like that. Then we have finally the change in PE. Change in P stroke E is change in the price to earnings, change in price to earnings ratio. Yeah. That is, in simple terms, the Greenwald-Kroner model, where we try and predict or we try and factor in the inflation, the growth rate in the long-term growth rate, the changes in supply of the asset, and also the change in the price to earnings ratio. Remember, we had looked in market-based valuation. We had mentioned the PE as the market price per share divided by the earnings per share. That's how we compute the PE ratio there. Now, we move on and look at the Cobb-Douglas economic function. Why these models are useful under equity market equilibrium is because when trying to predict the point, or the point where we have the supply of securities or the asset versus the demand, we need to understand these estimates or the estimates of required returns so that we can correctly predict the equilibrium price of the asset or the security there. Now we move on and look at the Cobb-Douglas economic function. Cobb-Douglas economic function. Cobb-Douglas. Cobb-Douglas, you're seeing economic function. There. Now, what we need to do is that just need to know how the formula looks like in trying to estimate the economic output of securities, or the general economic output, which is based on total factor productivity and labor inputs there. So we write the equation over here and say that the Cobb-Douglas economic function, before we write the equation, we mention something brief about the Cobb-Douglas economic function. This function is used to estimate the output which are factors, which includes factors of production, which includes factors of production, including, we can say, the total factor productivity, total factor productivity there, which also includes the amount of labor, the cost, the amount of labor. Just pause, cut. 3, 2, 1, action. So we are saying, once we look at the total factor productivity, the labor, we also look at the capital stock. Capital stock there. So the how to measure real economic output, we can't be able to write the equation. The equation is given as follows, where we have y is given as AK. I'll be able to explain all of those inputs over there. Then we have power alpha. Then, of course, this is multiplication there. And then we have the value of L, the labor component, which is given by beta here. Now, this the Y, rather we start with Y, is real output there. Then A, we can say that A is the total factor productivity. Total factor productivity there. And then K, we are saying, is the capital stock. And then we say that L is the labor output. This alpha represents a constant there. So this is a constant, and also that is a constant. These are constants, and also beta is also constant, like that. So those are constants there that relate. This is a constant. Alpha is a constant that relates to capital stock. Then beta is a constant that relates to labor there. So you should be given something that is very specific. Or this constant relates to the capital stock, and the other one relates to the labor productivity. Now, building on this Cobb-Douglas equation, we will assume that that we will be able to now get the change in y, or we put natural logarithms on this, so that we can be able to try and remodel this Cobb-Douglas equation to become something that analysts can be able to use in the financial services industry to try and predict output, the real output there. So we're saying applying natural logs natural logs, we have, so we apply natural logs and we divide each component. So we have change in y over y there, which is given as change in a over a there. Remember, we are applying natural logs, so this one comes down there. So we'll have plus alpha change in k over k, plus we will be able to now be given this constant over here. Now this constant can be expressed in terms of the alpha there, so we're saying where beta can be equal to 1 minus alpha, like that. So that is a very critical assumption that we need to make in the Cobb-Douglas equation. So we are saying that now bringing this component down, we are saying 1 minus alpha. We've already explained that beta will be 1 minus alpha there, and then we multiply by change in labor over the labor output component there. So this is what we're saying is the remodeled Cobb-Douglas equation there. What we can do is that summary, we can be able to say that the Cobb-Douglas equation is given as change in y is equals to change in a plus alpha change in k over k, rather not over k, change in k plus 1 minus alpha change in L, right there. So that is how we are saying it should be the Cobb-Douglas equation. So we try to look at an example that can be able to apply this concept of the Cobb-Douglas equation. The example reads as follows. When performing an analysis of 3 economies, an analyst compiled the growth and elasticity data in the following table. So we have country A, B, C, the percentage growth in total factor productivity 1, 2, and 3, the percentage growth in capital stock, that is the K component, is 2, 2.5, and 8. We have the growth in labor input 1, 4.5, and 2.5. Output elasticity of capital. That output elasticity of capital we are saying is the component of alpha. We have 0.5, 0.3, and 0.7. Required for each economy, determine the expected 10-year average annual GDP growth rate there. And number 2, comment on the 3 economies there. So when you're told to compute the expected or the forecasted GDP growth rate there, then we will be able to apply the Cobb-Douglas equation. Over here we say solution, there we say based on the inputs we are trying to estimate change in y. So the change in y in the first case, we can have a summary here, scenario 1 like that. So we say change in y is given as, now we have the A component, we said A is the total factor productivity over there. So we have 1 which has been given to us. You can be able to see correspondingly there country A there. So we are working with country A there. So we have 1 plus, we say we've already been given the output elasticity as 0.5. So we need to put 0.5 as that alpha component multiplied by the cost, the capital stock, the capital stock which we've been given as 2 there. Then plus, now we have 1 minus alpha they are given to us. So 1 minus 0.5, which you're saying is 0.5, and then we multiply by the labor component there. The labor component which you've been given there is 1. So that is the first case. That in the second case, we can be able to first of all combine them, then we'll be able to work them out. Change in y in the second case, and we have 2 given to us plus 0.5 multiplied, rather is it 0.5? I can see it's 0.3, pardon me, 0.3, which you're saying is the component of alpha multiplied by 2.5 plus, now we have 0.7, 1 minus 0.3, which you're saying is 0.7 multiplied by how much? You can see 4.5 there. How much do we get? Then number 3, we have change in y given as, we've been given the A component, which is saying is total factor productivity, as 3 plus, I can see 0.7 multiplied by 8 is what you're saying is the growth in capital stock there, plus 1 minus 0.7 there, times, we're saying we have how much? 2.5. How much do we get in the 3 cases? Very quickly we compute. So we first of all work in brackets over here like that. So we have 0.5 times 2, of course that is 1. So we have here 1 plus 1 plus 0.5 multiplied by 1, which you're saying is 0.5. 0.5. So here we have 2.5. And of course it's percentage. Yes, so that's 2.5% in the first case there. In the second case we have 0.3 multiplied by 2.5. We have 0.75. So it's 2 plus 0.75 plus we have 0.7 multiplied by 4.5. We have 3.15. So how much do we get? 3.15 plus 0.75 plus 2. We have 5.9%. So these are the figures that we will be trying to evaluate based on the economies, the nature of the economies, based on these inputs: the capital stock, total factor productivity, and the labor output. And we'll be able to make a decision in part 2. Now here we have 0.7 multiplied by 8. We have 5.6. So it's 3 plus 5.6 plus we have 0.3 multiplied by 2.5. We have 0.75. How much do we get? We add 5.6 plus 3. We have 9.35%. 9.35%. So those outputs or those growth rates are the ones which we'll be able to try and describe under part 2. So that is part 1. We've been able to compute the output there. Part 2 is asking comment on the 3 economies. So we're saying that economy A would appear to be a market close to equilibrium. Why? We are saying because the expected annual rate of growth is only going to be about 1%. We've already been given that 1% right over here. So we are saying that that is large developed economy. So that is what an analyst should be able to infer based on the input given there. So you're seeing the total factor productivity as being 1%. You can see the growth in capital stock is almost close to the total factor productivity of 1 as well. We're seeing the growth rate in labor is growing at 1%. We're saying that this one in conclusion would be a large developed economy there, which is close to equilibrium there. In the second case, we are seeing that the workforce growth rate is at 4.5%. That is the growth rate in the labor input given to us there. However, we can see that that has an impressive workforce which contributes towards the economy. They significantly contribute towards the economic development, and hence we are saying that this could be a relatively small economy such as Kenya's, where you're seeing a lot of the labor contributes towards economic growth there. You can see even the 5.9% is almost close to what we are seeing our economy is actually growing by, about 5-6% there. Or 6.5% is almost close to this one here. So we're saying that that is a relatively small economy that is driven by workforce. In the third case over here, we're saying the capital stock is expected to increase significantly over the next 10 years because we're basing our estimates here on 10 years. And we're also saying that the increased economic output, why we are saying the increased economic output is of this component of 0.7. The economic output over here would mean that the economy is larger and more developed, and it is growing at a very fast rate. We are saying the economies such as of Malaysia and Indonesia could be at this level over here. We are saying it's moving at 9.35% there. That is what we can be able to infer based on those computations right there. Now, having looked at the Cobb-Douglas economic function, we can be able to conclude around that point, and we will be able to continue in our next lesson by looking at the macroeconomic forecasts based on the H model and looking at the relative equity market valuation model, where we look at the Fed model, which is used in the US, the Yardeni model, and also the 10-year moving average price. We will be able to conclude our next lesson by looking at the asset-based approaches to equity market equilibrium, where we will be able to look at the Tobin's Q. Thank you for joining me. We hope that you will be able to join us in our next lesson.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.
Hello learner, welcome to Manifested e-learning forum. My name is Emlyn Gwiri. I'll be taking you through equity investment analysis, and we are looking at equity market equilibrium. In this second lecture, what we will be able to look at under equity market equilibrium includes the following. I'll be able to first of all try and highlight what we had looked at in the first lesson. We had looked at justification for short-term and long-term equilibrium. Then we went ahead and looked at the Greenwald-Kroner model. Greenwald-Kroner model. We went ahead and looked at the Cobb-Douglas equation, Cobb-Douglas equation, which tries to measure the long-term growth rate in output. And what we will now look at in today's lesson, so these ones were actually covered, that was covered, that and that was covered. Now we will be able to look at the macroeconomic forecasts, macroeconomic forecasts, and we will be able to look at the H model and the H model there. Then we will move ahead and look at something else, including the relative equity market valuation. So relative equity market valuation approaches. And what we'll specifically look at, we will be looking at the Fed model. So we'll look at the Fed model. Then we will also move ahead and look at the Yardeni model. And then finally, we will look at the 10-month or the 10-month moving average. So the 10-month moving average, or 10-year rather. It should be 10-year, not the 10-month. 10-month moving average. 10-month moving average computation. Or we will be able to just try and provide some summary on this 10-month moving average. Then we'll also move ahead and look at the asset-based approaches. Now the asset model includes Tobin's Q. Asset model. 2 valuation of equity market valuation asset model, and we'll look at now the Tobin's Q. Now to start off, we will look at macroeconomic forecasts and the H model. Macroeconomic forecasts and the H model. if you recall, under dividend discount model or discounted dividend model, what we had looked at, we had said that the H model, to determine the price of the intrinsic value of a security, is given as the D naught 1 plus G over R minus GL. This is growth rate in the long term there. Then we add now the D naught, which is the historical dividends, and we multiply that by the half-life in years of the duration within which the security prices or the dividends are expected to decline linearly, and then we multiply by G, the growth rate in the short term, the difference between the growth rate in the short term minus growth rate in the long term, right there. So we are saying the mechanics or the explanation for the H model is that if these are dividends and this is time like that, under the H model, the dividends are expected to decline linearly like so, and then it stops there, and now it now declines or stays stable like that in the long run here. So here we have the stage 1 and here we have stage 2. This is a much more realistic approach to trying to estimate the intrinsic value of a security. Why? Because dividends can be able to decline, or at times they actually decline linearly like that. Under the two-stage model we had mentioned, we have this approach over here. You have dividend growth rate like that. In the two-stage, the dividends are at that level over there, then they just decline suddenly to a stable stage like that. So this is stage 1 and stage 2. This is not realistic. This is, of course, an explanation in theory. It's not, doesn't happen like that in practice. But here we expect at least this case and the dividends to start declining like that slowly, or what we can say linearly to a stable stage like that in perpetuity like that. So this is what we will be able to build on the H model. Now, to apply the H model in macroeconomic forecasts, the formula is as so. You can be able to see the similarities between these. Let me leave that over here. So we are saying the macroeconomic model under the H model will be P naught, will be given as a D naught over R minus GL. That is the growth rate in the long term there. Then we have here 1 minus the growth rate in the long term like that, plus now the half-life in years, which you're saying is N over 2. For consistency purposes, let's explain it in terms of the H part. So it's H over 2 like that. Then the difference between the growth rate in the short term minus growth rate in the long term like that. That is how you compute the price of the equity index or the changes in the equity index based on the H model. So this D naught we say is dividend, the current dividends there. R is the required return there. GL is long term growth rate like that. Then what we haven't described here is H is the half-life in years, half-life in years like that. Then GS is the growth rate in the short term growth rate. P naught is the expected price of the index. So we can be able to now infer something from this macroeconomic focus and the H model. Let's try an example that can be able to reinforce our understanding. So we have an example that reads as follows. Assume that we have the required real return on equity being 10%, a current dividend of 12, the current supernormal growth rate of 10.5%, a long-term sustainable growth rate of 3%, and a 30-year period of linear growth decline is expected to decline. The estimated intrinsic value for the index will be how much? Assuming that the price to earnings ratio is 20.3. what will be the justified PE ratio. So we're saying we try and put the inputs. We try and identify the inputs. We're trying to estimate the P naught there. So we're saying we have D naught. So solution. Here we have D naught over R minus GL. Then we multiply that by 1 plus GL. 1 plus GL right there. Apologies, I must have made a mistake over here. This should be plus. Please change that to plus. Yes, that is 1 plus GL right there. Then plus the half-life in here is H over 2. Then we have GS minus GL right there. So D naught, how much have we been given as the dividends? The dividends, we've been told that the current dividends is 12. So it's 12 divided by the required return. The required return, which we've been told as the real return on equity, is 10%. So 0.1 minus the growth rate in the long term. We have been told that the sustainable growth rate is 3%, 0.03. Then 1 plus the growth rate in the long term, we have it over here, 0.03, plus the half-life in years. We are being told it is a 30-year period, so we just take 30 over 2. Then we take the growth rate in the short term minus the growth rate in the long term. The growth rate, we've been told the current supernormal growth rate is 10.5%, so 0.105 minus 0.03. So how much do we get as our P naught? Very quickly, work it out. So we work the brackets first, and we have, let's work this component first right over here. So we have 30 divided by 2, we have 15, and then we multiply by the difference between 0.105 minus 0.03. We have 1.125. Then we add this part over here like that, 1 plus 1.03. So we add plus 1.03 there, we get 2.155. So we have 12 over 0.1 minus 0.03 multiplied by 2.155 there. So we divide that, then multiply the two components there. So 12 divided by 0.1 minus 0.03, we have 171.428. So we have 171.428 multiplied by 2.155. We have multiplied by 2.155. There we have 369.4. 369.43. Like that. That is the new value of the index there. Now we have also been requested to compute the PE ratio there. Now this being the price, the P stroke E ratio of the index will be the market price per share divided by the earnings value they are given to us. So we are saying that it's 369.43 divided by the earnings, and the earnings we have been given there as how much? 20.3. From the question we've been given 20.3 there. So how much is our PE value? Divided by 20.3, we have 18.189. So 18.198 times, because it is a multiple, we must put times there. Now, having looked at the macroeconomic focus and the H model, we move on and look at the relative equity market valuation approaches right here. So we will look at the Fed model, the Yardeni model, and the 10-month moving average there before we conclude by looking at the Tobin's Q. So we can move on right here. And we look at the relative equity market valuation. Approaches. Equity market valuation approaches. The first one, we will begin with the Fed model. Yeah. Now the Fed model is a model that is used by the US Treasury, where they are able to try and predict the valuation or the estimate of the equity market movements. So we are saying the Fed model is given as the following. So we are saying the Fed model ratio is given as the S&P or the Standard & Poor's earnings yield there divided by the 10-year yield, treasury yield. There. That is how you can be able to get the Fed model ratio, and this Fed model ratio tries to predict the equity market value or the value at any given point in time. Now moving on, we look at the Yardeni model. Yardeni model. There. Now Yardeni model incorporates a component of risk in the model, but it's still based on the earnings yield as specified by the Fed ratio there. So we're saying the earnings yield E1 over price naught is given as YB minus D represents a weighting factor, and here you have long-term earnings growth component there, where E1 over P naught is the earnings yield there. Then we have now the YB is the corporate bond or the rating of the corporate bond, or the A-rated corporate bond yield there. D represents a weighting factor, usually around 0.10. You must be given that there, or you need to estimate the weighting factor when trying to estimate the earnings yield. And then we move ahead and look at the L tag. There we are saying is the long-term earnings growth. There, the long-term earnings growth there. Let's look at a model, an example that can be able to try and estimate the earnings yield, or we can be able to also estimate the price component there. Assume the long-term 5-year growth forecast is 9.85% and D is 0.1. If A-rated corporate bond yields 6%, determine the fair earnings yield. Part 2 is asking if the current earnings yield implied by the equity index and projected forward earnings is 5.5, determine whether equities are over or undervalued. Part 3 is asking, using the Yardeni model, calculate the fair value of the market PE ratio. So using the model, the Yardeni model, so we say solution there. Using the Yardeni model, we have it right over here. We have E1 over P naught YB minus D L tag there. So the YB, what is the yield that is yielded, that is being provided by the corporate bond? We are saying is 6%, so it's 0.06 minus the D component, which we are saying the D represents the weighting factor. We've already explained it over here. We've been given 0.10 like that, and the long-term earnings growth rate we have been given as 9.5%, 0.0985. Yes, like that. So how much is the earnings yield? So we're saying is 0.1 multiplied by 0.0985. There is 0.00985. So we get 0.066 minus the answer. We have 0.050, 0.05015, or we are saying it is 5.015%, like that. That is the long-term earnings yield. That is part one. Part two of the question is asking if the current earnings yield implied by the equity index and projected forward earnings is 5.5%. Determine whether the equities are over or under valued. So we are saying that the rule of the thumb in equity investment analysis, if the current market price is greater than the intrinsic value is what you believe the value of the equity index should be, then you are saying it is overvalued there. But if it is the contrary, if the current market price is less than the intrinsic value, undervalued, like that. So in this case, we are comparing the 5.5%, 5.015, which we are saying is 5%, and the 5% or 5.5%, which have actually been given there. So we are comparing this with the 5.5%. So we are saying that the 5.5%, the current market earnings is 5.5%, and this would imply that the Adani model, based on the Adani model, it is undervalued. So what happens is that we are saying that the intrinsic value is 5.5% there, and this one, the current market price, is 5.015. You can see the current market price is less than the intrinsic value, and hence it is undervalued there. Part 3 was asking, using the Adani model, calculate the fair value of the market PE ratio. Remember what you're saying, the PE ratio is the market price per share divided by the earnings per share. So what we just need to do is that we just get the inverse of this value. Let me explain it like so. So we're saying here we have part 3. We have E1 over P naught. Now the inverse of this, we are saying, will be the P naught over E1. That is the PE ratio. So from your calculator, you can just get the inverse value of 5.015, or we are saying you can get 1 over 0.05015. We'll be able to get the P stroke E value. In this case, how much is that? So 1 divided by, so we are saying we get 19.94. 19.94 times. That is the PE ratio there. Having looked at the Adani model, done the Fed model, the Adani model, and the 10-month moving average, what we just need to understand under the 10-month moving average is that it is not usually used, because the 10-month moving average requires an individual to just get. So we're saying we get the 10-month moving average. What we need to do is that we get the earnings for the 10 months. So January, February, March, April, May, June, July, August, September, and October there. So we're saying this represents 10 months. So we get the earnings yield for this period over here, and we compare them with the previous 10 period moving average there, and with that will be the estimate of the market. Is it going to be a positive increase in the value, or is it going to provide a negative value? Now you're comparing this for the current period versus the previous 10-month period and trying to determine whether it has actually increased or decreased. That is what you're saying is the 10-month moving average in trying to estimate the equity market or determine the equity market evaluation for the market there. Now moving on, we will now need to look at the asset model. And in this case, the asset model is based under the Tobin's Q here. So we say the asset model there. This model is based on the computation of Tobin's Q. Now, what we need to understand under the Tobin's Q is that it is the difference, rather, it is dividing the asset market value with the assets replacement costs. So, assets market value divided by the assets replacement cost. That is how we get the Tobin's Q there. And now, breaking it further, we need to get the market value of debt plus the market value of equity. Then we divide by the assets replacement cost, so that we can be able to determine the value of the index or the value of the equity market there. So we can be able to break it further. Here you say Q is equals to market value of debt plus market value of equity divided by the assets replacement cost. Assets replacement cost there. Having looked at all of these components, this brings us to the end of equity market equilibrium. We hope that you have enjoyed this lecture, and thank you. God bless you.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.
Hello learner, welcome to Manifested e-learning forum. My name is Emlyn Ngwiri. I'll be taking you through equity investment analysis, and we are looking at technical analysis. In lesson 1 and lesson 2, we had looked at the mechanics that drive the technical analysis, and also looked at the door theory, including the postulates of technical analysis. In lesson 3, we will specifically be looking at the following: analysis. There. We will be looking at the moving averages. So under the moving averages, we are looking at the mathematical indicators. These mathematical indicators are what technicians use to try and infer an uptrend or a bullish market or a bearish market. We had already explained that in our previous lessons. Now, under mathematical indicators, we will specifically be looking at moving averages. That's the first kind of mathematical indicator. Specifically, we'll be looking at the simple moving average there, and then we will move ahead and look at the exponential moving average. Exponential moving average there. Once we've looked at those two moving averages, we will be able to now look at the oscillators. And specifically now we'll be looking at the rate of change. Yes, we'll be looking at the rate of change, like that. Once we've looked at the rate of change, we will now also move ahead and look at the relative strength index. Strength index there. And then finally, we will be looking at the moving average convergence divergence. Moving average convergence divergence. There. What technicians call MACD. MACD. Moving average convergence divergence there. Now, having looked at the mathematical indicators, we will look at the market indicators there. So we look at market indicators there. Now, under the market indicators, we will be looking at the breadth of the market, Then we'll move ahead and look at something else that talks about new highs and new lows. New highs and new lows. There. New highs and new lows. These are indicators that technicians use to try and predict the strength of the market or the strength of a particular trend. Now we will also move ahead and look at short selling. Short selling there, and we will conclude this topic by looking at the odd lot trading. Odd lot trading, like that. Now these indicators right over here are important for technicians, because these are the ones that guide them to infer or make very critical decisions as to whether to buy a security or actually sell a security. So moving on, we will now start off at the mathematical indicators. Mathematical indicators. There. Now the mathematical indicators, as described over here, and we will first of all begin with moving averages. Now under moving averages, there is the simple moving average there, a simple moving average, where we are saying is a description of where you will be able to have, if you have the period given to us there, and then we have the price of the security over here, and we're saying that the period 1, 2, 3, 4, 5, 6, 7, let's go up to 10, 9, 10, like that. The prices here you have 20, 23, 25. These are just hypothetical examples. 24, 28, 26, 25, 23, 20, and 21, like that. For you to conduct a simple moving average, say for example a 5-period or a 3-period moving average, what will happen is that you will be able to take any 3, like that. You get you sum them up and you get the average of those prices, and you plot them and you put them right over here. So you say, in this example, you say 3-day moving, 3-day moving average, 3-day moving average, like that. Now the 3-day moving average, what we're saying is that you'll add these 3 here. So let me pick my calculator right over here, and we say that now in this case we will have 20 plus 23 plus 25, like that, equals, you divide by 3, because you're looking for the 3-day moving average. You have 22.67. 22.67. Notice where I'm putting the 22.67. It's at the midpoint right there. So the next figure, we get 23. We'll get now these 3 right there. So we have 23 plus 25 plus 24. Divide by 3, we have 24. Like that. Now these 3 again, we continue like that. 25, 24, and 28. 25 plus 24 plus 28. We have 77 divided by 3. We have 25.6. 25.6. Notice what we are doing. We are conducting a 3-day moving average for each 3-day period, so that now when we are plotting now the price over here, the price against time, like that, what happens is that we will be able to now plot, first of all we'll plot the period against the price there. So probably you'll be able to have something like that. Just for example, that's what you're having. And then this 3-day moving average is what is going to reinforce the investor or the analyst in terms of whether there's going to be an uptrend or a downtrend. That is the way it is going to appear, like that. So it will have to start from some point in the middle over here. It will not start from the grid like that, from the x-axis, rather from the y-axis over here. It's just going to begin from the center and trying to be indicative of a trend, either up or down, like that. That is what a simple moving average is. So now we can be able to put it in writing and say, is that it represents an average of the security prices over time, and is useful to analysts and investors who would be able to infer a trend. Brackets, you can put bullish, bearish, or no trend. So once we have that now, we are saying that this can be able to assist technicians as well as investors to try and infer either bullish, bearish, or no trend. Now this is very useful, especially when you want to determine the strength of a trend. This case, you are not, you cannot be able to infer anything because this represents the congestion area where you're seeing it's actually oscillating, moving up and down like that. So you can't be able to infer anything from that. Yeah. Now, having looked at the simple moving average, let's look at the exponential moving average right here. So we are right here, exponential moving average, exponential moving average, exponential moving average. Now, under the exponential moving average, you will be able to have to apply a formula that can be able to assist us to compute or get an indication of whether the strength of the market is actually moving up or moving down. Now, what we need to do is that we need to determine the following. We need to first of all get the formula for computing the exponential moving average, and the formula is as follows. We are saying the EMA, which you can be able to say is exponential moving average, right there, right there, is given as, and the first value we need to identify is we need to look at the previous EMA, exponential moving average. Previous, I will be able to explain exponential moving average, like that. Once we identified that, then we move ahead and we add the closing price. We add the difference between the closing price and the previous exponential moving average. So we add the difference between the closing price minus previous exponential moving average, and then you multiply by a constant there, which you're saying is f there. Now f is given as, so f is given as 2 over n plus 1, like that, where we are saying n represents the moving average that we're actually looking at. We've already explained the simple moving average. We said we use the 3-day moving average, so we can be able to have some hypothetical data over here so that we can be able to demonstrate how to compute the exponential moving average. So we are saying we've got period 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10, like that. We have the price like that, 20, 22, 23, 25, 22, 26, 29, 20, 22, and 21, like that. That is just a hypothetical example. Now, in this case, to compute the exponential moving average for the first period, what we need to note is that for the first period, we will assume the price to remain the same over here as 20, like that. Now, once we have that, for every first period when computing the EMA, we will always assume that. Now, coming back to the formula, when come to the second period over here, We are saying we have the previous EMA, which we are saying the EMA previously. In this period right over here, period 2, the previous EMA is 20 right over here. If you'll allow me, I can use the formula, compute the formula right over here, or rather down over here. We can say the EMA is given as, now we are coming here, the previous EMA we've been given as 20, plus, now, the difference between the closing price right there, the closing price right now is 22 minus the previous EMA. The previous EMA is 20 like that, and then this component F, or the factor, the constant F is considered. We are saying we are going to try and consider a 3-day moving average. So we are saying it's 2 divided by 3 plus 1. So we are saying it is 2 divided by 4, which we are saying is, this is 1, this is 2, which is 0.5 like that. So that is how we compute the F over here. So the F we can say is 0.5. So to compute the EMA, the current EMA for today, how much do we get? Okay, we have 22 minus 20. We have is 20 multiplied by 0.5. We have 11, then plus 20 like that. Plus 20, and we have 31. Let me confirm that again. It's 22 minus 20, and we have 2 times 0.5, and we have 1, and then plus 20. Plus 20. That's why it's always important to always confirm. This gives me 21. Like that. Assuming now we continue like that, that's for the second period. For the first period, we have is 20. For the second period, we have as 21. For the third period, how much do we have? We are saying we'll have the previous EMA. The previous EMA is 21 plus the closing price is 23 minus the previous EMA. The previous EMA is 21 multiplied by 0.5. Notice the 0.5 will be constant because you're saying is 2 over 4, which you're saying is 0.5 there. So how much do we get? We say we have 23 minus 21 like that, and then we multiply by 0.5, then we add 21. We get 22. And so on and so forth. That is how you get the exponential moving average. So in trying to plot the price against the price against the period over there like that, and you're saying over here you have something like the price here against time, which you're saying is the same as the period. You will be able to plot this against the price, which will move like something like that, for example, and then we're saying the EMA will start from somewhere over here and move like that. That is a mathematical indicator that is used as well by technicians. Now, having looked at that, this brief description, that is how we are expected to compute the exponential moving average there. I don't need to put any description. It is pretty direct. You just need to understand the formula, the previous EMA plus the closing price, and the difference between the closing price and the previous EMA multiplied by a constant, which you're saying is F, and N represents the number of moving averages there provided there. Now those are the two. This is B right there. A is simple moving average, B is exponential moving average. Now we move on and look at the oscillators right over here. Now under the oscillators, you're trying to see whether how erratic a given market is. So we can say provide an indication of how erratic the market is provide an indication on how erratic the market is based on some computations, including the first one, which you're saying over there, is the rate of change. Number one, rate of change there. Now, looking at the rate of change as a way of trying to provide an indication of how erratic the market is, we are saying it is given simply by, this you can say is ROC, is given by, ROC is given as the current price divided by the price prevailing in period n plus 1. Price prevailing n periods ago multiplied by 100, like that. That is why we can be able to compute the rate of change. So you need to have the current price given to us over here, the price prevailing, say maybe 1 year ago, like that. You divide by that and multiply by 100, you see the rate of change. Has it increased or has it decreased there? That provides an indication of the oscillation within the market there. Having looked at the rate of change, we now look at the second one, number 2, and based on our summary here, having looked at the oscillators, we've looked at the rate of change there, the relative strength index, relative strength index. Now, the relative strength index needs us to compute the relative strength of the market. And how do we compute the relative strength? We are saying, first of all, RSI, or the relative strength index, is given as 100, like that. Then we minus 100 divided by 1 plus the relative strength. Yes, the relative strength, like that. So this is minus there. This is 1 minus. The RSI is 100 minus 100 over 1 plus the relative strength gives us the relative strength index. Now, how do we compute the relative strength? The relative strength is the average gains. RS is given as average gain per day divided by average loss per day. That's how we compute like that. So if we have a listing, if you'll allow me to just try and put something over here, you have period 1, 2, 3, 4, 5, 6, like that, and you have them on day 1, maybe there's a gain of 5, a gain of 6, a gain of 2, and like that. Then on period 4, from period 4 to period 6, you had losses. So we're saying the losses include maybe say loss of 3, loss of 2, and loss of 2 there. So what we're saying is that you first of all compute the relative strength, like that, the average gains over the average losses. So how much are the total gains? This is 5 plus 6 is 11. This is 13. That is in terms of gains. 5 plus 6 plus 2, like that. And then here we are saying you get the average losses. So it's 3, this is 5, this is 7, like that. So it's average gain over average losses. So in this case, the average, so we're saying is 13 divided by 3 and 7 divided by 3, and we divide those two, we get the relative strength. Once we have the relative strength, we come and plug that inside this formula over here. That will be able to help us and provide an indication of the oscillation within the market. So we get 100 minus 100 over 1 plus the relative strength. So let's just do it over here, so that we can be able to understand how we compute the relative strength index. So we're saying the average gain, we have 13 divided by 3 right there. I have the calculator right here with me. 13 divided by 3, we get 4.33. So it's 4.33, which is the average gains divided by the average losses. So we have 7 divided by 3, like that is 2.33. 2.33. So how much do we get? 4.33 divided by 2.33, and we have 1.86. 1.86. Now that is the relative strength, and we come and plug that in there like as I was saying. So RSI is given as 100 minus 100 over 1 plus relative strength 1 plus the relative strength is 1.86 there. Remember the law of Bodmer's? That brackets should begin first. So we're saying we have 100 divided by, open the brackets, 1 plus 1.86. 86, close the brackets, equals, we get 34.96. So 100 minus 34.96, which we're saying is how much? 65.03. That is the relative strength. We are saying that the market is fairly strong, because you're saying the 50-point mark. 50-point mark is where now it's the middle ground between whether the market is actually weak, and on this other side is where the market is actually strong. So you can see 65 has actually passed the 50-point mark, and that's indicative that the strength of the market is fairly strong there, like that. So having looked at the relative strength index, we can move on and look at the moving average convergence divergence, MACD, which you're saying is a very important oscillator for technicians. Moving average convergence divergence, into brackets MACD. There. So the moving average convergence divergence is a pretty simple concept, because it tries to indicate the strength of the market. And how do we compute the moving average convergence divergence? We're saying we just need to understand the strength of this indicator by looking at the strength or the premise behind the oscillators. We're saying the premise behind the oscillator provide an indication of how erratic the market is based on some computations, including those ones there. So we're looking at short-term exponential moving average, and that the difference between the short-term exponential moving average and the long-term exponential moving average gives us the moving average convergence divergence. So we're saying short-term, put it like so, short-term exponential moving average, or we can say, yeah, exponential moving average, like that, minus the long-term exponential moving average gives us the moving average convergence divergence, or what we're seeing the MACD there. Once we look at that, then we're seeing that will be an indication of the market oscillator, or the market, how erratic the market is there. Now, once we've looked at the oscillators, the mathematical indicators, now we move on and look at another concept that deals with the market indicators. This was the mathematical indicators. Please note, this is mathematical indicators. All these, we're talking about moving averages. And then now we're looking at the oscillators there. Mathematical indicators, now we're looking at the market indicators. The market includes either the fixed income market or even the equities market there. So we'll move on this side. Now, market indicators. The first one that we will be able to look at is the breadth of the market. The market. Now, the breadth of the market means what? It means that we are trying to look at how the market is, or the composition of the market. And it's a very simple concept, where we are saying the information ratio is given as the information coefficient times the breadth of the market. That is the simple relationship that you need to understand as an equity expert. Where we are saying IR is the information ratio That is the information about the market, which is comprised or comprises of the information coefficient, there, and BR represents breadth of the market. Now, how do we get the breadth of the market? It is just the difference between the average gains divided by the average losses in a given day. That is how we can be able to get the breadth of the market. We are also saying that the breadth of the market can also be gotten by the number of securities within the exchange. So we are saying the breadth of the market represents the number of securities traded in a securities exchange. Number of securities traded in a securities exchange. That is the breadth of the market. The information coefficient is the represents the skill of the manager, represents the skill of the manager in trying to predict the market up or down. That is the information coefficient. The information ratio is the ratio that relates to the information about the market, or you get an inference about the market there. So we can say information ratio, you can say information ratio provides an indication to technical analysts, to technicians about the factors that contribute to the return of a market. Return of a market. There. So we are saying the information ratio is linked with the information coefficient and the square root of the breadth of the market. The breadth of the market represents the number of securities. The information coefficient represents the number of skills, or the skill, how skillful the manager is in trying to predict either uptrends or downtrends. So the information ratio is also given as active return over active risk there. This is the return beyond the benchmark, which you can be able to run RP minus RB. This is the return of the portfolio. This is the return of the benchmark. Then we divide that against the active risk, which you are saying is the standard deviation of returns between the portfolio and the benchmark there. The difference in the risk between the portfolio and the benchmark. That's how we also get the information ratio coefficient. Now, having looked at the breadth of the market, let's look at new highs and new lows. Look at the breadth of the market, we look at new highs New highs and new lows. And new lows. Every time a technician tries to perform a trade within the market, what you need to understand is that the market will provide new highs and new lows every time or every say 5 or so days, like that, because of what you're saying, the end of week effect, end of month effect. Those are calendar anomalies that affect securities exchanges all over the world. So this concept of the new highs and new lows is a pretty old concept, but it has an impact on trying to predict the market as whether it's going to move in an uptrend or whether the market is going to move in a downtrend here. So we say the new highs and lows is important in the prediction of market movements up or down, and we can say represents an indication, an indication of potential strengths in trend movement, indication of potential strengths in trend movement for, we can say, for technicians. There. That is what we say about the new highs and the new lows. So if you keep on finding a securities market, if you can be able to probably use this other side to try and demonstrate or expound on that, what we can say is that if we have every time this is the price and this is time, and we find every time you find a new high every day like that, you find every time you're moving like that you find a new high like that, it means that that is indicative of an uptrend like that. So this is a bullish market. So you find new highs every single day like that for, say, consistently for the past 1 month, that should indicate a bullish trend. However, if you have the contrary view or contrary opinion, where you have new lows every time that you are trying to identify the market trend like that, that indicates a bearish trend. That's why new highs and new lows is important for technicians to try and determine the nature of a given trend there. Now, having looked at new highs and new lows, let's look at short selling. Short selling. There. Short selling is a concept that is pretty new in our market here in Kenya, because we are saying that the short selling regulations are being introduced by the Capital Markets Authority, where securities can be sold short. How does that happen? This is the exchange there. This is your firm. It is a dealer with the exchange, like that. And these represent investors right here, both institutional investors and individual investors there. This firm can say, probably maybe we have another firm right over here like that, and this is the broker, apologies. Broker. So this is your firm right here. You go to a broker, you tell them, okay, that you need some to buy 1 million shares of KQ, Kenya Airways. The broker comes and tells you that fine, we will be able to offer you the shares, but we need to have a contract written down, and you need to sign, and we also need to sign, so that the contract can become binding. So the broker goes to the exchange, buys the 1 million shares like that, and now the shares are now with the broker. The broker can now offer them. Remember, there has not been exchange of money here. So they offer the shares to the exchange, to this company over here like that, at how much? So you're saying it's 1 million shares at, say, maybe 4.5 shillings like that. That means that shares worth 4.5 million shillings have been transferred from the broker to this firm here. Once those shares are received by X, they now avail them to these investors at a premium. Probably it is 1 million shares, 1 million shares at maybe say 11.5, or let's say 10 shillings. Let's just, for convenience purposes, let's put a 10 shillings there. So we are saying that 10 million will move from these institutional investors or individual investors back to this firm. But remember, this firm right here had been provided or had borrowed shares from the broker over here like that. So now, since the proceeds are with firm X there, or this company here, what happens is that 10 million is with the firm, but what it did is that it borrowed from the broker, so it needs to pay up 4.5 million there. So now from the 10 million, using this dotted line overhead, gives 4.5 million. That is the principal amount that had been provided by the broker. So 4.5 million, but there needs to be some form of interest that is paid from the proceeds there. So we can say plus an additional maybe 2 million. So you're saying this is the principal 4.5 plus the interest of 2 million. So now total comes to 6.5 million like that. Now the remainder of the balance, which you're saying is 3.5, remains with firm X there. So firm X has made a profit from the usage of shares, or from the transfer of shares from the broker, which it did not ordinarily have. Well, that is what you're saying is short selling. Selling securities that do not belong to you. So we can be able to put that explanation in writing here. It is the process of selling securities that do not belong to you. Put it like that in quotes. It is the process of selling securities of selling assets based on borrowed funds or assets. There. So I've already explained what short selling is. Now, trying to link it with the market indicators, we may not be having these short selling regulations having been finalized, but what we need to understand is that those short selling regulations, if an increased case of short selling actually happens, then that indicates the vibrancy of the market. So we can say if short selling is rampant, then the market is said to be very vibrant and is in an upward spiral, that saying bullish trend there. That is what you're saying is short selling. But of course, the contrary is where we are saying the bearish market will actually happen. Now, having looked at short selling, we move on and look at the odd lot trading. Odd lot trading. Every securities exchange has an odd lot segment where you have securities that are not in multiples of, say, 100 and 100. For example, if you want to buy, the securities market is providing that the bid price is 4.5 for KQ. This is the buying price for KQ. You must come in multiples of 100 shares. So that means you can, for the minimum you can be able to buy in the main market segment is 4.5 times 100. You must spend 4,500 so that you can be able to buy 100 shares like that, or 450 rather, like that. It's 450, sorry about that. So this times 100 is 450, like that. For companies, say, which have got maybe, say, like EABL or East Africa Breweries Limited, which are going for so to the tune of maybe 320 shillings, you must come with 32,000 so that you can be able to buy 100 shares there. There is another segment apart from this main market segment where you must buy in multiples of 100, which we're saying is the odd lot segment. The odd lot segment now is where the shares are traded in multiples less than 100. You can find 99 shares, 96 shares, 98 shares there, 93 shares, 53 shares, or even 5 shares are actually traded in that market. This is where investment banks and stock brokerage firms usually buy shares at a low price. The rule of the thumb is technicians need to buy shares at the lowest price possible and sell the shares at the highest price possible. So you are supposed to try and ask your broker, stock brokerage firm or investment bank, how much are the shares for Kenya Airways or for KQ going under the odd lot segment. Please don't go buying shares at the main market segment. Insist that you want to buy shares under the odd lot segment there. That is what stock brokerage firms and investment banks don't tell you. And it is unethical for the investment community to actually allow that to happen. What should happen is that I am telling you right now, you need to go and ask for the odd lot segment and buy shares right there. So odd lot trading is the process of buying and selling securities in the odd lot segment of an exchange. It is the process of buying and selling securities in the odd lot segment of our securities exchange. That odd lot of segment of securities exchange, like that. Now that is what you're saying is the odd lot trading. You need to note and you need to underscore that or underline this statement, that under the odd lot segment you will be able to find a significant discount in the prices of securities. A significant discount of securities prices are provided for under the odd lot trading. This brings me to the end of this topic review, and before I end, I need to give you a series of questions that you should be able to try and look at. The first question was tested in November 2016, question 5B. It reads as follows: explain the term technical analysis as used in equity valuation. Number 2, discuss 3 principles underlying technical analysis. Now, there is also another set of questions which I'll give you, and these questions came in May 2016, question 4A. It reads as follows: examine 4 principles of door theory in relation to technical analysis. Number 2, explain the reasoning behind support level and resistance level in relation to technical analysis. And finally, part 3, the exhibit below relates to Fairmore Limited, a company quoted at the Securities Exchange with a 50-day moving average and relative strength compared to Standard & Poor's S&P Industrial with 50-day moving average for the year 2014 and 2015. So you have the graphs indicated there. Required: interpret the chart output lines labeled 1 to 4 in A3 above. Thank you for having me as your guide. We hope that you can be able to join us in our next lesson. Thank you and God bless you.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tomboya Street, Pioneer House, 3rd floor, opposite Fire Station.
Hello learner, welcome to Manifested e-learning platform. My name is F.A.M. Ningwiri, and today, ladies and gentlemen, we are discussing about the business data analytics, December 2023, question 22. It reads as follows: Safari Limited is evaluating a project with the following details. You've been given the initial investment, 100 million, residual value, 10 million, year 1 projected project cash flows is 25 million, the annual cash flow growth rate from year 2 is 10 million, the project life is 5 years. You are required: A, compute the following project metrics: payback period, number 1, number 2, the net present value, assume a discount rate of 12%, number 3, the profitability index, assume a discount rate of 12%. B, using a graph, determine the project's internal rate of return. And this totals 30 marks. So trying to answer this question gives us or gives you 30 marks there in total. So to start us off, we are first of all going to do the following. We're just going to first of all come right here and we say we have the year given to us over here. Given to us over here. And this solution over here, I can just drag this one down over here. This is A. And this gives us year. So we have the years given to us. They're from year 0, 1, 2, and of course you know what happens once you put it like this, and then you have that plus sign like that, you can drag it up to the number of years you actually want, like that. So let's assume it goes all the way to year 5. Not assume, we've been told it goes to actually to year 5, and you can be able to see the project life right over here is 5 years. So from year 0, and we are saying from there then we need then to put the value over here. We're dealing with Kenya shillings, so shillings, put shillings. And we are saying we can put them in thousands. That. All of these need to be put in terms of thousands over here. That. Why? Because we're dealing with thousands. We just do not want to deal with very big figures like that. We just want to deal at least with manageable figures. And from there, we can put over here the initial investment. That. Then we can put the initial investment right here as 100,000. Why am I putting 100,000? Guys, because you're saying that we are expressing it in terms of thousands over here. Yes, it's 100 million, but if you remove those 3 zeros there, we're saying we're dealing with 100,000. And because we want to deal with values that are in terms of the accounting format, so let's put it like that, then just do it sort of something like that. That looks at least well presented, presentable, I mean. So initial investment is that. Then we have the residue value or residual value. that. And the residual value is assuming that you sell the asset at the end of the project, or after 5 years there. So right here I can put over here, in terms of the residual value, you can put 10,000 here. You sell an asset and you realize 10,000 in terms of value. Once that happens, then we can move ahead and look at the values over here in terms of the net cash flows over here, the cash flows. Cash flows. And you're seeing the cash flows over here we've been given. The initial investment is 100 million. You're seeing the project 1 cash flows is 25 million over here. So assuming that this is, of course, is the initial investment, we can put a negative value over here like this. We're saying that we can be able to put, so it's negative, I just sort of put negative, enter. It can be able to appear, and that it's an outflow. We can put the values over here as follows. For year 1, we're saying is 25,000. Not right there. You can put, because this is the residual value, the cash flows here, 25,000. That. And we're saying this 25 million or 25,000 over here, in our case here, is going to grow at an annual rate of 10% from year 2. So from here, we can do sort of something like so. We add that value and multiply it by a factor of 10%. So times 1.1. That. We get 27,500. Then we just drag it, because this has got a formula. We drag it sort of like that. And we make sure at least it auto fits within the cells. So from there, we are saying that what is going to be our net cash flows? Our net cash flows are going to be as follows. Flows. Then. So here we're going to pick this value here. The ones we're going to discount, these ones are going to use this value here. And then we are saying we're going to use, just going to pick the residual value plus the cash flow itself over here, if any. So that now after period 5, we expect this cash flow to be 46,603 over here to be the cash flow you're going to discount back to period 0. So we drag it and it picks. You can see now these are the cash flows which you're going to discount over here. You can put them in bold, Control B. That, of course, we can be able to expand it by sort of clicking, double clicking like that. Those are the cash flows. Once we have that, we can then get the payback period. So over here I can write now the payback period. Because that's what you're looking for, payback period. This means that we need to get the cumulative. Cumulative values. I can be able to just put it sort of like that, and we come right here and put it maybe in form of a box like that. So that's what you're interested in, the cumulative cash flows. So here it's just going to be that value, and then we are going to pick plus that value plus this net cash flow here comes to 75, and then we reduce it. We continue, we drag it because it has got a formula. We continue up to there. But if we continue over here, if we get 33,000, we subtract, because of or 17,000, we subtract 33,000, we should be able to get a positive value. What the payback period tries to measure is how much you can be able to recoup this original investment of ours over here of 100,000. So clearly over here we'll be able to get a positive cash flow, yes. But in terms of the payback period, in terms of years, you can see the number of years given to us right here. We can say that the payback period, so payback period here will be given to us right over here. So this is year 1. We can say year 1, indeed, we're still getting a negative cash flow. Here, year 2, we're still getting a negative cash flow. Year 3, we're still getting a negative cash flow over here. But when we reach year 4, we are going to get a positive cash flow. This, let me just demonstrate. We're just going to get a positive cash flow over here like so. And that's not what we want. We want to recoup this original investment. We do not want a positive cash flow. We want to see the exact number of years we're able to recoup this 100,000 right here. So just delete that. We know it is going to be 3 years, but 3 years and how many months? So we can be able to put the number of months right over here, or we can be able to compute it right here. So it's going to be that value over this value, and then we multiply by 12 because we want it in terms of months. Like that. So 6.22 months. So the payback period you can see is, we can say, is here. Payback period is 3 years, 6.22 months. That is what answers our first part right here, the payback period. So we can move ahead to part B, the question over here. And part B, we can just go down right here. B. It's a similar fashion or a similar format. We are looking for the net present value right here at a discount rate of 12%. So net present value. Net present value. And we're saying the net present value is, just given, is just how much we are able to get. Are we going to realize a positive cash flow or a negative cash flow based on discounting? You're using a discounted cash flow technique so that you can be able to get the present values. And in a similar way over here, so we're not in B, we're doing part A, part 1. So this is A, part 1. I can just put it like so. This is A, part 2. A, part 2. Like that. So that now we can be consistent there. And to get the net present value, what we'll need to do, if you allow me to copy this over here like this, cash flow, the cash flows over here, I can be able just to copy these ones the way they are like that. Copy, just put them just down here. So, and of course, I'll be able to also copy this. Allow me to copy this. Copy, put it just down here like so. And this I can drag it maybe down. I can just drag it somewhere down there like that. So the initial investment, we pick it from above here. That's the initial investment there. No problem. The residual value, we just pick this from above here. And then we're saying the cash flows, we're just going to pick whatever we have right above here. So we're linking it like that. And we're saying these cash flows are the ones which we will need then to discount. So this is how we're going to discount it. So the net cash flows, we still pick them from above there. Net cash flows like that. And then we have this value like that. And this is what we're going to discount. These ones over here. These net cash flows. You see, like the way I've did over here, the relevant values, these are the ones which are going to we're going to discount and get the present values right over here. So present values. So the present values will be, we're going to get this value over 1 plus r over here. But for us to be able to get the present values, or there's in Excel, there's always a way we can be able to get the present values. Always. It's always a way how we can be able to do it. And we can just say the NPV. Instead of discounting this value over 1 plus the discount rate power 1, this value over 1 plus the discount rate power 2, power 3, power 4, and power 5, like that, we can just go to the to a formula NPV, like that. And we are saying, we open it up right here, and we can see the rate. The rate is just 12%. And once we have the rate as 12%, under the value 1 here, we put in those cumulative cash flows like that. And then we will need then to subtract the initial cash outlay. So would it be correct for me to add right over here? We add the initial cash outlay there, like that. That's the initial cash outlay. So that's what we are saying we are going to have. 13 million, of course, because we're dealing with millions, 13,365,099. That is what you're saying represents NPV. And so you can maybe highlight the answers maybe in red like that, so that you can be able to know that these are the answers. We can move on and discuss about the profitability index. The NPV, before we move on to the profitability index, the NPV is the net of present values to try and see whether you're able to get a positive cash flow or a positive value or a negative value. If NPV is positive like this, we accept the project because the project is going to yield us positive values in future. But if you get a negative NPV, then it doesn't make any sense to us here. So here, part 3, I can move ahead right down here and now click this one to be 3, the third one. That. A, part 3. We talk about profitability index. That. Under profitability index, we are going to get the present value of cash flows divided by the initial cash outlay. That gives us the profitability index. Any number greater than 1 gives us positive, or we are supposed to go ahead and invest in that project. If it gives us anything less than 1, then we reject the project. And we are told to assume the discount rate of 12%. So what we do is that we just go ahead and use similar values right over here. Copy. We come right here, or rather I should have copied from here, sorry. Copy, and you put it right maybe just down here. Paste special, we want to paste special formulas and all. Oh, it's refusing, so we just look for an alternative way, put it like that. So with these values, we can just link it with the first value right over here. So just link it with that one, that, and we can just drag it moving across like that. The residual value picks from here, that. So these represent the net cash flows. So this is what we're seeing is shillings, so just delete this and it's okay. But the initial investment picks from here, the net cash flows, that value there. So once we have that, then we can be able to get the profitability index. And the profitability index we are going to get present value of cash flows divided by the initial divided by the initial cash outlay. So we're going to use NPV rate 12%. The values, we are saying we're going to use these values here. And there's one thing that we needed to change here. We need to add the two values, these two values here, before we continue. That one plus that one there. See the profitability index, NPV. See here, double click it. Then we open it up right here. And you see the rate is 12%. And then with 12%, we can put in the values over here, like that. We are getting that value, the present value of cash flows, and we are going to divide this against the initial cash outlay. So minus, open the brackets, this one. Enter. That's what we get as our profitability index, 1.13. So in this case, we accept this one based on NPV, we accept, and the payback period, if it's the shorter the payback period, the better it is for us. So here, just like for consistency purposes, we put it in red like that. And we can see that we're moving on well, and we now move on to part B of the question. Using a graph, determine the project's internal rate of return. The project's internal rate of return is at the point where you get, the NPV is equals to 0. Where the NPV is equals to 0 is where we are saying our project's IRR is going to be. And so we're going to use a graph. So first of all, you're going to test it using the IRR formula. So IRR, or internal rate of return. Rate of return. The internal rate of return, IRR, is going to be, we open it up right over here, the values. So we put the values right over here, all of the values, including the negative value here. And we say, okay. So it's around 17%. And that's what we expect, or 16.75%. That's what we expect from using the graph, around there about. So he picks arbitrary rates, so 12%. You can put 12% over here, 13%, like that, and so on and so forth like that. So we just drag it. So we can just get arbitrary rates over here, and we get the corresponding NPVs. So NPV over here, 12%. The rate is 12%. You can see from right over here, 12%. The values over here are these ones here, the net cash flows here, like that. And then we do what? We add the initial cash outlay. The initial cash outlay in this case was negative here, that, and we get that value. So it's the same as what we got above over here. That's fine. But because we want to ensure that we want to get the corresponding NPVs at different rates over here, I need to lock the formulas over here. So I press F4 there. I click over here, I press F4, and I press F4 over here, so that I can be able to lock and ensure that everything is okay. So if I drag my formula over here, it should be able to work. So that's what I'm going to do right here. So shift, Control D. But it's picking 13%, or it's because I didn't change. You see, it's still at 12% here. So what I'll do, I'll just change this to 13%, 14%, like that, 14%, 15%, and so on and so forth. Just come and change here, 16%, 17, that, then 18. So don't worry about that. 19. Then here we got 20%, 20%, like that. So you plot a graph over here. This is the NPV. NPV, that rate. Like that. So just sort of put it center to make it look presentable, and like that. Then you can just draw a graph here. Insert. Then you come to recommended charts, and you can be able to see, based on this graph over here, that point, okay, just place it somewhere right here, that at around 16% over here, you can see at around this point here, if you click right here, it will give you the point. At around 17% is when you're going to get negative NPV thereabout, 17%. And you can see it's 16.75 right here. So the exact rate should actually be somewhere over here where it's next to, it's along just this curve over here. It cuts it along this axis over here like that. NPV indeed is at 16.75. So once you draw the graph like this, it should be able to, and then you just highlight like this, you can be able to see thereabouts around approximately 17%. You can be able to get the IRR. So ladies and gentlemen, this brings us to the end of the class. We have done question 22 of the Business and Data Analytics paper, which came in December 2023. Hope you have enjoyed it. God bless you all. Bye-bye.
How are you over there? My name is Patrick Kamau Kamure. You are lecturer in taxation. Welcome to today's lesson of public finance and taxation, where we continue looking at the taxation of the business income, where, if I can give you a little of recap of what we did, is that we said that there are three businesses that we need to see how they are taxed. One of them is the partnership, is the sole proprietorship. The other one is the partnership, and the third one is the limited company. In our previous lesson, we did the taxation of the sole proprietorship. So for today, we want to go to the next business, which is the taxation of the partnership. So partnership is where we have two or more people who come together to do business together, and they don't register their business as a company. Because of that, we normally say that partnership do not have a separate legal entity from the owners, and that will mean that when you are taxing the partnership, you tax the partners themselves, not the partnership itself, because it is not separate from the partners. They are partners, and the business, they are one and the same thing. So now we want to see, how do we normally tax the partnership business? First of all, I want to write over there the introduction or definition of the partnership as I've illustrated. So we have partnership is a business owned by two or more people which is not registered as a company, and so does not have a separate legal entity. That is the definition of the partnership. But our objective or goal is to know how we usually tax the partnership business. So these are the items that you need to consider when you are taxing the partnership business. So areas to consider, or items to consider: while taxing partnership business. Number one, determination of taxable income. Determination of taxable income, and say this is done using either or A, gross profit method, or number two, or B, net profit method. What we are saying is that when you are determining the taxable income of the partnership, just like other business, and as we introduced earlier on when you are introducing to the taxation of the business today, any business, when you're determining the taxable income, you either use the gross profit method or net profit method. So the same criteria apply to the taxation of the partnership. You either use the gross profit method or net profit method to get the taxable income. We have Roman 2. Another items that you need to consider when you are determining taxable income of the partnership or taxing the partnership is the following expenses: are not allowable in partnership. I.e., salary to the partner, to partners, interest on capital, from partners to the partners, commission and bonuses to partners, drawings by partners, and any private expense of the partners. That is the second thing that you need to know, that those expenses, when they are incurred by the partnership, they are considered to be non-allowable expenses. Salaries to the partners, interest on capital, bonuses, the commission, the drawings. In short, we are saying any expense relating to the partner like private expenses of the partner. We don't allow them when you're determining the taxable income. The third one that you need to consider, the following incomes. Are non-taxable incomes in partnership, i.e., what are those incomes that are not taxable? Interest on drawings, profit on goods sold to partners, and any other income. Any other income from partners. That's another thing, that when you're determining the taxable income of the partnership, if there's any income that the partnership received from the partners, we treat it as non-taxable. This you hear like interest on drawings, like when the partner withdraw anything from the partnership, like goods, the cash, they charge interest. That is an income to the partnership, but it is usually not taxable. Another thing is like sometimes they can have a provision, or the partners can have a provision that if a person wants to buy goods from the business, can buy and they are going to be charged a profit like any other customer. So that profit is not taxable in the partnership, and any other income that the partnership may get from the partners. The fourth one is the income distribution schedule. Distribution schedule. What does that mean? Once taxable income of partnership is determined, it is distributed to partners using income distribution schedule where they bear individual tax burden. They are taxed individually at graduated scale rates in the same way as employment income. After the distribution. The gross tax. The gross tax, once determined, then set-offs such as personal relief, insurance relief, and withholding tax on investment incomes are deducted. Income distribution schedule as the following format. So what we are saying is that about the income distribution schedule. Once the taxable income of the partnership is determined, either using the gross profit or the net profit, we tax the income on the partners themselves. And we tax them at graduated scale rates. Graduated scale rates is the same as the employment income, the way we taxed the sole proprietorship, where once you distribute to the partners, because the partners are the one who bear the tax burden, you tax them individually. It is partner A, how much is the taxable income? Tax individually at graduated scales. Partner B, how much is the taxable income? Tax them individually. And then once you get the gross tax of each partner, you less the set-off. Set-off, we said that they reduce the actual tax they are supposed to pay, and they are like personal relief, the withholding tax on investment income, and insurance relief if they have life insurance cover, education insurance cover, or NHIF. Now, I want to show you how the distribution is done through the income distribution schedule or allocation schedule. So it has this format: income distribution stroke allocation schedule. We start by distributing the taxable operating income, and then we list the partners. Partner A, we are assuming partners are A, B, and then we have a column for the totals. Shillings, shillings, shillings. So the taxable operating income you would have determined using either gross profit method or net profit method. You can distribute it this way. The first one is usually the salary. So salary to partners. If partners have the salaries, if this one had a salary, you put there this one and the total. The next one is interest on capital. Interests on capital. So interest on capital for this partner, for this one, and this, if there is any. Then commission or bonus. You put on this, this, and this. After that, those three are the one that you usually post. If there is commission or bonus, interest on capital, salaries to the partners. Then you less interest on drawings. Interest on drawings. So interest on drawings here, you less if anybody withdrew the goods and they were charged interest there. Now, after you have distributed those one, the taxable operating income you'd have determined, you minus what you have distributed, minus this, minus this, minus this, but this one you add. Then whatever remains you share according to the profit sharing ratio. We call it profit share. Shared according to profit sharing ratio. So you come, how much is this? This total. And then after that, get the total taxable operating income. Total taxable operating incomes means we take the salary, the interest on capital, if there is commission or bonus, less interest on drawings, profit share, you get the total here. You do the same for this, you do the same for that. Now, you have just distributed the operating income. Then you add taxable investment income. Taxable investment incomes shared according to profit sharing ratio. Sharing ratio. So if you have something like rent, non-qualifying dividend, non-qualifying interest, royalty, all those, remember, withholding tax is not final. You come and share here according to the profit sharing ratio. This one, total. And then now from there, you can get total taxable income. Total taxable incomes, which will take the operating income plus investment to get the total. Operating plus investment, operating plus investment, there. And now, if you're asked about now taxing, getting the tax payable by partners, you'll tax this one A individually on this using the graduated scales, the way we tax a sole proprietor's income. The same case, this one, A, B, tax on this one to get the tax they are supposed to pay. So that is what you need to know when you are taxing the partnership business. And from there now, I want us to look at a question. So I read the question, then I'll show you how it is solved or computed. This is what the question says. Hi there, my name is Patrick Kamau. Welcome to today's lesson of Public Finance and Taxation, where we look at the taxation of farming activities. So farming activity is somehow connected to the taxation of the business that in our previous lessons we have covered, because all matters is how is the farming activity carried out. Is it done by a limited company, a partnership, or a sole proprietorship? So when it comes to the taxation, determination of the taxable income, everything remains the same. So the only difference are just two things that you need to know. Additional taxable income in farming. Those are incomes that are specifically for farming, in addition to the one that we said are taxable under normal business, and also additional allowable expense. The one that we talked about are still applicable, and now they are those specific in farming because farming is a special activity. So I want to write something about the taxation of the farming activity here. Before then, at the end of it, we look at a question. This is what you need to know, that farming is also called agriculture. And it involves keeping of animals or growing of crops for food or commercial purpose. When farming is done for commercial purpose, then the income generated become a taxable income. Another point is farming is taxed depending on how it is carried out, either in partnership, by a limited company, or sole proprietor, where it is taxed in the same way as these businesses as already covered. However, the following apply specifically in farming. So we have number one, the following specifically apply in farming. We have additional taxable income. This includes all incomes generated in farming, i.e. income from selling of crops, livestock, farm produce, animal produce, etc. Before we continue, what we are saying is that, as I had introduced, that you do farming either for food, for commercial. If you do farming for commercial purpose, then the income you generate become taxable profit like any other business. Now, how do you tax the farming activity? It depends on how it is being carried out. Is it being done by in partnership? You tax it in the normal way, like a partnership, the way we have covered in our previous lesson. Determine the taxable income, then distribute the income to the partners, then tax them individually. Is it done by a limited company? It is a company, determine the taxable income of the company, then tax the company, just normally. Is it done by a sole proprietor, where you determine the taxable income of that sole proprietor, then tax him? However, we are saying the following specifically apply in farming: additional taxable income. Like that, any income that come out of farming activity, like selling of crops, livestock, animal produce. Animal produce are like eggs, milk, hide for the animals. All those are supposed to be taxable, and any other income that come out of farming activity. Then we have number two, additional allowable expenses. Additional allowable expenses. This include, we have A, costs of purchasing seed, fertilizer, and livestock. B, we have farm operation expenses. Such as cost of water, electricity, transport, etc. Then we have C, costs of clearing land and planting permanent and semi-permanent crops. D, costs incurred to prevent soil erosion. Soil erosion, i.e. construction of gabions, terraces, and making of windbreaks. The last one, capital allowance. Capital allowance on capital expenditure or farm work costs. This one, check capital allowance computation. So what we are saying is this: when you see these expenses and they are incurred in farming, treat them as a allowable expense. One we are saying is the cost of purchasing seeds, fertilizer, and livestock in farming. They are allowable. Treat them as a allowable expense. Farm operational expense, just like any other business, water expense, electricity, transport, and any other expense incurred in farming, allowable. Cost of clearing land and planting permanent and semi-permanent crops. Permanent crops are the crops that can be in the farm in the long term, like coffee plants, tea plants. The cost of planting them are allowable. Semi-permanent are like pyrethrum. They're usually in the short run, but 2, 3, 4, 5 years. They are all allowable. Cost incurred to prevent soil erosion, like construction of gabions, terraces, making of the windbreaks. All these are allowable as long as they are to prevent soil erosion. And capital allowance on capital expenditure in farming. Capital expenditure in farming is also called farm work cost. So when you see farm work cost, claim capital allowance under farming. And this I'm reminding you to go and check the capital allowance computation because we learned about it. Now at this moment, I'd like us to look at a question to see what we are talking about. So I read the question. This is what the question says. Mazao Ranch Limited practices mixed farming and milk processing. The following is the company's statement of profit or loss for the year ending that 1st December 2020. We have the revenues consisting of sale of milk, sale of livestock, sale of manure, proceed from the sale of an old tractor, discount received, expenses which we have general expenses, construction of water tank, vaccine for livestock, loan repayment, depreciation, electricity and water, conveyance fee, construction of chicken sheds, animal feeds, salaries and wages, bad debt provision, repair and maintenance, professional fee, net profit. Additional information number 1, farm work acquired on 1st July 2020 comprised of the following: granary, labor quarters, cow sheds. Number 2, general expenses include subscription to a farmers association, acquisition of a 50-year lease, staff Christmas party, parking fine. Then number 3, repair and maintenance comprised, provision for fencing expenditure, repair to machinery, other repairs. Number 4, professional fee include 500,000 paid with regard to pursuing a dispute with the Kenya Revenue Authority, VAT department. Then assume corporate tax rate during the year was 25%. Required adjusted taxable profit or loss for Mazao Ranch Limited for the year ending that 1st December 2020 and the tax payable if there is any. So in this case we take note. Yes, it's a farming activity, although they are mixing it with processing, but the key thing is farming activity. And then the farming is done by a limited company. So whatever we have been saying about a limited company apply with addition of this additional taxable income we have talked about and additional allowable expense. So we treat it as a normal, it's a company actually. So the next question should be, which method are we supposed to use to get the taxable income? Like any other business, for this one we use the net profit method because we have been given the net accounting profit after the income statement. So this is how we go about it. For the year ended that 1st of December 2020. So we start with net profit provided, which we have 157,000. Then when you are using the net profit method, we said you add non-allowable expenses in P&L and taxable operating income not in P&L. So just like we have been using the net profit method, we'll go through the P&L, look for the expenses that are not allowable in the P&L first. So which expenses are in the P&L? General expense. General expense we have been saying is allowable is for the business. Construction of water tank. We don't allow water tank, that's a fixed asset. So construction of water tank, a fixed asset we don't allow. Of which case we have 240 had been deducted, isn't allowable. Next, vaccine for the livestock. That is allowable expense, vaccine, because it's a farm operational expense. Loan repayment. We said loan repayment is not allowed. What we allow is the interest on loan, not the loan. So we disallow that. Loan repayment, 350,000. After that, depreciation. Depreciation isn't allowable, so we add it. Depreciation, which you have 180,000. Electricity and water, that is allowable expense. Conveyance fee, no. If you go to the regular expense, we said conveyance fee is not allowable. And which we have 156,000. Then construction of chicken sheds, that's also a fixed asset, you know, a structure. We disallow. Chicken sheds, a fixed asset for 80,000. Animal feeds, that is an allowable expense. We said an operational expense. Salaries and wages is allowable. Bad debt provision. Provision we don't allow unless they are specific provision. So we disallow that. Bad debt provision, which we have 150,000. 150,000. Repair and maintenance, that is allowable, and also professional fee are allowed. From there, we go to the additional information we look for, an income not in P&L. If an income is not in the P&L, can only be in the additional information. And if it happens to be taxable operating, we add. And at the same time we go there, we look if there is an analysis of the expense in P&L. In the analysis, if they do happen to be non-allowable, we add still. We start with the additional information, number 1. Farm work acquired on 1st July 2020 complies of the following. Now, farm work, that's a fixed asset. We said here, it's a capital expenditure. We don't allow capital expenditure. We claim capital allowance. But those expenses, if you look at them keenly, they are not in the P&L, so we cannot touch them. Then number 2, general expense include. Now, general expense is one of the expenses in the P&L, so we look for the non-allowable expense in it because it's an expense in the P&L. Subscription to Farmers Association, that's a trade association which we allow. Acquisition of a 50-year lease, that's allowable. We said up to 100 years, up to 99-year lease is allowed. Staff Christmas party allowed for welfare. Parking fine, we don't allow fine. So in this case, we disallow. Which we have 129,000. Then after that, we go to number 3. Repair and maintenance complies. Now, repair and maintenance is in the P&L. So we look for the non-allowable in it. Provision for fencing expenditure. We don't allow provisions. So we add provision. Only specific provision for bad debt do we allow. This provision for fencing, it's not specific provision for bad debt. For fencing, which we have 145,000. The other one is repair to machinery, that is allowed, together with other repairs. They are all allowable, revenue expenditure. Then we go to number 4. Professional fee include. Now, professional fee is in the P&L. If you go to the P&L, the last expense is actually the last one. Is in the P&L. We look for non-allowable in it. It includes 500,000 paid with regard to the pursuing dispute with Revenue Authority VAT. We said any expense relating to tax we don't allow. So we'll have a professional fee for VAT, $500,000. We don't allow. Number 5, assume the corporate tax rate during the year was 25%. That's not an income, it's not an expense. So we are done with an allowable expense in P&L, an income not in P&L. Unfortunately, we didn't come across any. Now we now come to the deduction. Remember, we deduct 3 items: non-taxable operating income in P&L or investment income in P&L and allowable expenses. Allowable expenses not in P&L. So first thing, we go to the P&L. We look for non-taxable operating income there. And also the same P&L, we look for all investment income there. Let's see. In the P&L, these are the incomes. Sale of milk. We said sale of milk is a taxable income. Taxable operating in farming. Income from selling of an animal produce. We said here under taxable operating income. Sale of livestock are taxable operating for farming. Sale of a manure, that's an animal produce, a taxable income. Proceed from the sale of an old tractor. Under normal circumstances, we don't tax income from selling fixed asset. That's a fixed asset. So profit